Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 297th VideoCast podcast for the week ending June 26, 2025. Got a lot of great stuff to cover this week, but as always, family first. Annie Esbar, the Spanish Olympian, invited Mimi to have dinner on the pool deck with the Spanish national team after their game on Sunday, and Annabelle spent the weekend in Northern California at Superfinals where her team got silver, and then she came home to an incredible article tribute by Swim Swam. So excited for that. Headline, Annabelle Hayes adds to nationally best times in 6 events at SCS Nova June Age Group Championships. So that was pretty cool. What else we got here? That was the article. That's me in front of Fox. That is on set at the Big Money Show, Jackie DeAngelis. That is Charlie Gasparino, Cheryl Cassoni, of course. Here's the article. Another terrific performance for 10-year-old Annabelle Hayes at the SCS Nova June Age Group Championships. Hayes set personal best to win the 50 freestyle, 28.90, 200 free, 2:15.42, 50 backstroke, 33.31, 100 back, 109.72, 50 butterfly, 30.82, and 200 individual medley, 229.87 in the girls' portion of the meet. In the 10 and under girls age group this season, Hayes is now the fastest times in each of those events. Hayes was a big reason Irvine Nova Aquatics easily won the combined girls team titles. That's very kind. All right, so that's in front of the New York Stock Exchange. Never gets old. That's in front of the CNBC booth. That's with Brad Smith over at Yahoo. Had a fun time there. This is the control booth where they produce while it's going on live. That's with Josh Lipton, one of the hosts at Yahoo. That's also in front of the studio there at Yahoo. That's on set with Stuart Varney and John Castamas-Tides. He's a billionaire oil guy and supermarket guy in New York City, Gristides. Outside Fox again. And finally, this is on set. You can see the teleprompters on Varney & Co. And that's that. So first off, want to thank Christian Dagger, Peyton Jennings for having me on with Stuart Varney. Thank you. We're going to listen in here.
Check out futures, please. The market's still looking favorably on the ceasefire deal and its continuation. Dow up 280, Nasdaq up 211. Tom Hayes with me this morning. I want to start with the oil price. Down again this morning. The last time we checked, it was $66 a barrel. I would suggest that that's a help to inflation down the road. Is it?
There's no question about it. This is the major component to inflation. And the Saudis are going to continue to pump. They don't want sanctions. They want to be helpful. The Russians are going to continue to pump. They need income. Oil is going to stay down. It's so funny. Everyone was all up in arms about the Straits of Hormuz. It's never been shut down. In all of these different battles, the Gulf War, et cetera, it's never been shut down. Oil's going to stay low. Inflation's going to stay low. Powell is going to have to move because the natives are getting restless.
You think he's got to lower rates?
Look.
Why must he lower rates?
Okay, Waller's come out. Goolsby's come out. Bowman's come out. Everyone's come out saying, listen, this is a temporary tax, if anything. It's even in their summary of economic projections that it's going to be temporary. And by the same token, their projections, 1.4% real GDP. If GDP is going to be that low, he should have done 50 basis points in June. He's got to go. He's going to try to push it off to September, and that'll probably be okay. But now you got more and more people coming out. Maybe we get a surprise in July.
How low could the price of oil go? I was going to ask you that, but I really need to know.
Well,
can you get back into the 50s? And will American drillers drill and pump if it's in the $50 barrel range?
At 50, it's a little tougher for them to pump aggressively with rates at this rate. If rates start to come down, we could see some pumping in the 50s for sure, and that would keep oil low for a long time. But Powell's got to move.
All right, let's talk stocks for just one moment.
Yeah.
If we get the big, beautiful tax break, okay, if we get that, if we get a rate cut by the Federal Reserve, if we get the ceasefire holding in the Mideast, does the market rally significantly?
Listen, we are going to new highs. I told your audience a few weeks ago we're going to new highs this summer, probably before August. I'll tell you what's going on. Institutional sentiment is at near COVID lows still. Can you imagine that with markets near new time highs? Institutional sentiment you saw from Bank of America in the fund manager survey, near great financial crisis lows. The markets climb a wall of worry. These people are going to be forced in. We're going to get new highs in July.
Stay with me for the hour, please. Tom Hayes, thanks very much indeed. All up. Let's have a look at the energy companies. With oil down so much, we're $65 a barrel for oil. All of the energy stocks are down, and you're going to cover them for us, Taylor.
I mean, when was the last time that 72 hours ago we took out an adversary's nuclear arsenal in the Middle East and oil falls $12 a barrel? This is crazy world. But look, so the oil companies were up a little bit yesterday because, look, they can all make money at 50, 55 for break even. So when oil's at 80, great. Now that oil's back to $65 a barrel, a little bit less profitable for them to pump. So again, they fall along with the price of oil.
Tom, you made the point that they've never closed the Strait of Hormuz, and they're not going to do it now.
No, absolutely not.
And you could get oil below $60 a barrel?
I think you could. If rates come down, it becomes more and more profitable for them to pump at lower levels. But until, Chair Powell has been a little bit belligerent. The natives are saying, let's cut in July, and he says, no.
All right, let's have a look at the defense stocks, too. I believe they're mostly down, but Taylor, that's because of the ceasefire.
Yes, exactly. So we talked yesterday about traditional defense that was up as we were waiting for the escalation, and then traditional defense that is down as we've sort of gotten the de-escalation. Also, don't forget cybersecurity defense as well as another role in this, not as long with traditional defense as people were waiting for maybe a hack that could come to the grid. Again, that hasn't come yet.
Bitcoin's back to $105,000 a coin.
We're close to a record, right? Like 110, 112 is a record. Look, this is a classic risk on, right? This is a market trying to figure out, do we like gold? Do we like dollar? Do we like Bitcoin? How does Bitcoin fit in a portfolio if it's risk on? So again, just another sort of classic risk on play today with the market.
Following stocks to some degree too.
Yes.
Dow's up 300. Fiserv, they're a fintech, financial technology company. What do they do? Oh, they're partnering with MasterCard.
Yes.
That's important.
To adopt stablecoin. FIUSD is the Fiserv's token, and they want to have it all across MasterCard products. So they want to allow customers to smoothly transition from fiat currencies to this stablecoin. They want merchants to also get paid if they wish in this stablecoin instead of a dollar or fiat. Basically saying that they want stablecoins to be ubiquitous across continents and across currencies, so that they think the stablecoin, again, is this new currency, if you will.
Tom, I thought the stablecoin was bad for MasterCard and Visa.
It's an uncertain period. Here's how I would hedge it, Stu. I gave your audience a stock called PayPal in the high 50s. It's now in the low 70s. They are the 6th largest issuer of stablecoins. So if you like the fee business, PayPal's got 450 million users. If you like the stablecoin business, they're the 6th largest issuer. That's the way to kind of hedge your risk until we get more clarity of how this is going to play out for Visa and MasterCard. I would not be a buyer of Visa or MasterCard here.
I think I got the point.
I love it.
Then we've got Uber and Waymo. They've launched their robo-taxi service in Atlanta. Okay, what do we know about that?
Stu, I keep giving you these little nuggets, these good stories, and you keep refusing to ride in an autonomous vehicle.
I don't go anywhere where they've got them. They don't have them in New York.
Well, they're coming eventually. But yes, the news today is that they're going to be opening up in Atlanta. So starting today, you open up your Uber app. You can either get an Uber X or an Uber Comfort, and you may get paired up with a fully autonomous Waymo, and they drive those Jaguar Pacer cars. But you can opt out. If you end up not wanting that, you can cancel it and switch to a non-fully autonomous ride as well. But basically all around downtown Atlanta.
Okay. I got the message on this one.
One of these days.
Why are robo-taxis such a lifesaver for Tesla and the rest of them?
It's a big deal, but let me tell you something. You can't make this stuff up. Elon Musk puts a couple cars on the road in Austin with drivers in the autonomous cars. He gets tens of billions of dollars of equity cap value. Waymo's been going for years. Google gets zero value for Waymo. It's already working. Everyone's driving around with no drivers. It's great. Zero value attributed to Waymo and Google stock.
All right, I'll move on.
Yeah.
Microsoft. Microsoft just hit an all-time high. And we've got some more drama between Microsoft and OpenAI. What is it now?
There is, there was a great story that, enterprise customers are having a harder time deciding to switch on over to the Microsoft Copilot AI AI. One executive said that ChatGPT is so fun that the Copilot is sort of losing out in ground to ChatGPT from enterprise customers. One executive said ChatGPT is fun. The Copilot from Microsoft is useful, but really only within the other suite of Microsoft products. So again, this is ChatGPT going up against the biggie, your Microsoft, and I did
Your
that for
Microsoft,
you.
as if I owned it.
I know you like it.
Tom probably doesn't know this, but I've owned Microsoft throughout the 17 years that this show's been on the air. Wow. And I owned it before I even joined Fox, and that's a long time ago.
That's impressive.
Yes,
Talk about compounding. This business has compounded their capital at double digits for decades now.
Get a winner and stay with it.
I love it.
As long as it stays winning, of course. Yeah. Amazon, I'm interested in this, even though I don't do delivery. They've expanded their same-day delivery service. Where now?
Yeah, so they're going to be investing about $4 billion to triple their delivery network by 2026. They're expanding same-day and next-day delivery to now more than 4,000 smaller cities. You don't just have to be in a big city. You can be in a smaller city and still get this service. And they don't have an exact amount of new facilities, but they said with each new facility that they bring, it will create on average about 170 new jobs.
Got it. Thanks very much. We'll see you on the Big Money Show, 12 noon. Tom, you got a couple of stock picks. You're starting with Advanced Auto Parts. That's not, I'm used to these huge gains that you get in technology companies. That's not very sexy. Advanced Auto Parts?
Okay, here's what I love to do, Stu. I'm known on Wall Street as Turnaround Tom. I like to buy high-quality companies when they're marked down. These two stocks I'm going to talk about are marked down 2/3, okay? They're great businesses. Shane O'Kelly's coming into Advanced Auto Parts. Average car on the road is 13 and a half years. They've mismanaged it. He's deleveraged the balance sheet, closed down 500 unprofitable stores.
Is it double?
This is going to, Advanced Auto Parts could triple over the next 3 to 5 years. Their margins have bottomed out at 2.5%. They're going to 7%. Last time they were high single digits. The stock traded at $150.
Okay. Show me Estee Lauder. I've got limited time here.
Okay.
You like it. Where's it going? It's 79. Where's it going?
It's going to 100 plus in the short term, talk about a year or less. And then beyond that, this thing could be a double from here.
Turn around, Tom. You got it. Thanks very much indeed. Coming up, President Trump has always pushed for America first. Watch. Yes, sir. Tom Hayes with me. I'm putting Boeing on the screen. I think that's the only defense stock that's up, and you're going to tell me why it's up.
Yeah, no question. We gave it to your audience, by the way, a couple months ago at 135 when no one wanted it. It's up at 203. But there were these multi-ton bombs that were dropped and decimated Iran's nuclear ambitions over the weekend. Boeing makes those bunker buster bombs.
They make the GPU-57.
That's absolutely right.
30,000 pounds.
Yeah, and did they work or not? They
worked.
They worked like nobody's business.
And Boeing's back to $200 a share. All right. Thanks very much, Tom.
Thank you.
Coming up, Trump's...
The United States.
So, rates down, no to the socialists, and you're not going to get out of Gristedes. John Katsomatidis, I don't care what you say. You're all right. Thanks for joining us.
Thank you very much.
All right. And Tom, thanks for being with us for the hour. I do appreciate that. Thank you. Still ahead.
And we're back. Then we're going to talk about, had the chance to go down to the New York Stock Exchange. Want to thank Mel Montanis and Kristen Scholler will listen in here.
So with all this data and the S&P 500 within striking distance of an all-time high, I do want to bring in Thomas Hayes. He's a chair and managing member at Great Hill Capital. Thomas, welcome.
Thanks for having me, Kristen.
Great to have you on the show. I think last time you were here, we had seen a lot of volatility in the markets. You were bullish. Are you bullish today?
We continue to be bullish. We have some tailwinds here, Kristen. First off, the ceasefire. I mean, Iran's nuclear ambitions were completely decimated over the weekend. Boeing bunker bombs absolutely decimated the site. Then you've got the big, beautiful tax bill. President Trump says, no vacations until we get it done. That's going to be very, very constructive in terms of tax cuts. And then we can get on with growth and deregulation. We went from tariffs and wars to growth and deregulation. That's a very positive thing. And then finally, the natives are getting restless. You've seen 3 dissenters come out against Chair Powell, with Bowman, with Goolsbee, and with Waller. And I think you're going to see more to follow. And I think the reason is very simple. You and I are paying an extra $600 billion a year in interest payments, which is entirely unnecessary with inflation where it is, and 72 million millennials who are desperately trying to start their lives in family formation can't afford a home, largely because of one man focused on his legacy, worried about becoming Arthur Burns, and the conditions of the economy and the population are nothing like the period that Arthur Burns was in power as Fed chair. So these are the three key tailwinds.
And you're referencing there Jerome Powell, obviously, the head of the Federal Reserve, driving the path forward for interest rates. He has said multiple times, Thomas, that he wants to take this wait-and-see approach, that he does anticipate that inflation will rise due to tariffs. So what is your response to that if, in fact, inflation does rise in the months ahead?
Look, it's very easy. If his look, the Fed mandate, they're supposed to be data dependent. He is now prediction dependent. Jay Powell is so certain that inflation is going to rise. But if you look at his summary of economic projections, he acknowledges it's a temporary bump. It's like a one-time tax. Also, if you look at his predictions, he's showing real GDP at 1.4%. If he believes in his own predictions, he should have cut 50 basis points in June. So you can't have it both ways. I think this is one of the first times in history we're seeing the Fed being prediction dependent versus data dependent. And that's a risk. And I think the pressure is on because, you know, if you look at the average age of a person buying their starter home, it's been pushed back, 5 some odd years because he got transitory wrong and he got autopilot wrong. So it's time to get it right. And this is a chance to preserve his legacy. And you know what? If he is right, he can always hike 25 basis points. It's much easier to quell inflation than it is to deal with deflation and unemployment. That's very, very costly.
Yeah, September 2022, that infamous transitory word, right?
Yes.
The one that you referenced there that many of us do remember when it comes to the path forward for Fed policy. So you're bullish, you see tailwinds. Thomas, what do you like in this market?
Yeah, I think you've got to be nimble here because we're going to push to new highs this summer, no question about it. But if you just buy the indices, I think you're going to be a little disappointed. You got to look under the surface for the things that haven't moved yet. If you look at earnings growth, so the Magnificent 493 first quarter, 27, the Magnificent 7 first quarter, 27% earnings growth. That will decelerate by first quarter of next year to 10.2%. The unmagnificent 493, the rest of the market went from negative earnings growth last year. It's going to be 10.3% by first quarter of next year. So basically what you have is 493 stocks earnings going up, multiple is much lower, and the 7 earnings growth basically collapsing and the multiple still high. So you want to look under the surface of the 493. I got one for you that you're going to love.
Yes.
Estee Lauder.
I know Estee Lauder well.
Okay.
And we've seen them down here on the floor of the stock exchange quite a bit.
Yeah, they completely screwed things up. Okay, but Turnaround Tom loves turnaround stories. Great businesses when they're marked down. Part of what hurt them was, in fairness, 2021 to 2024, the COVID policy in China was pretty rough. They have 30% of their revenues out of China. As bad as that was, and the stock's down 2/3 because of that, they did maintain 99% of their share in China. So as China is now starting to recover, they're going to get that tailwind. They're number one in the premium brand category in skincare and in cosmetics across the world. And they have more than one brand. Sometimes I say Estee Lauder and people go, oh, isn't that just mostly old ladies, blah, blah, blah. First off, it's phenomenal makeup.
They do well with my clientele, I'll tell you that.
Okay, well, you're too young for it. All right, Estee Lauder, they've got MAC, they've got Dr. Jart for the young kids, the Korean stuff, they've got Clinique, they've been buying and selling brands for over a century, and they're going to continue to do the same. They're going to pivot. They've got a margin reacceleration plan. They've got a new CEO in place. Deutsche Bank upgraded on Monday to $90. Stocks are 70, 75 right now. This can be a double over the next 3 to 5 years. We love high quality businesses. This is compounded capital at double digits for decades. It's going to continue to do so. Everyone wants to look and feel good, right?
Yeah.
Right.
We will be watching Estee Lauder indeed. Anything else, Tom?
Yeah, I've got a hairy one that no one's going to want, which I always have to bring you one that makes people a little bit uneasy. Advance Auto Parts, okay? They got it completely wrong. O'Reilly's eating their lunch, and they brought in a new CEO named Shane O'Kelly. He's been turning the business around. He came from HD Supply, $7 billion business at Home Depot. He sold off Canada, paid down some debt, sold off, closed 500 unprofitable stores, cleaned up. Now he's starting to re-expand. He's opening 100 new stores in those areas where he's number 1 and 2 in the market, which is 75% of the stores now, consolidating distribution centers to get the parts to the professionals quickly. Margins are going to expand from 2% to 7.5% over the next couple of years. Last time margins were that high, the stock traded about $150. It's only $50 right now. So we think that could be a double to a triple over the next 3 to 4 years.
So I do want to ask holistically, obviously it sounds like the Fed could be a risk to the downside if they are late on lowering rates, Thomas, but in terms of where we go from here, if you are bullish, what is your target for the S&P 500?
Yeah, that's a good question. In terms of the S&P 500, I don't spend a lot of time with that because I'm not correlated as much to the S&P 500. I look at discrete businesses. But I think we can, history says when you have this type of V-shaped recovery, 12 months out, after you rise 20%, as we have in the last couple months, the market's up on average another 20%. So I think 7,000 in sometime in 2026 is a realistic expectation. Probably towards the end of the year, this year, maybe 6,500, 6,600 would be a reasonable expectation. But new highs, and then we get into some fall volatility, and then probably year-end rally.
All right, we like to see a lot of green on the screen down here on the floor at the stock exchange. Thomas Hayes, he's a chair and managing member at Great Hill Capital. Thomas, thank you.
Thank you for having me. And we're back. Then I had the pleasure to be on Yahoo for the full hour as well. Here are the highlight clips with Josh Lipton. Want to thank Taylor Clothier-Smith, Josh Lipton, and Julie Hyman, who accused me of being an optimist. Guilty as charged. You can listen in here.
Let's bring in here Thomas Hayes as well as chairman and managing member of Great Hill Capital here with us as well. Thomas, I want to bring you in here. I bet you, Tom, there are some viewers who are watching this and they're saying, hold on a second. So the U.S. strikes Iranian nuclear facilities over the weekend. President Trump is dropping 30,000-pound bombs. Right? Then today, Iran fires missiles at a U.S. base in Qatar. And I'm looking at the popular averages, and you see green across the screen. That might be surprising to some people. Does it surprise you, Tom?
This is a case of sell the rumor, buy the news, okay? If the great Art Cashin used to say, you sell the risk of war, you buy the first attack. What you have here, though, and what we heard this afternoon from sources was that this was a call-in retaliation attack to save face. And once we knew the magnitude of the
Meaning by that, do you mean that Iran was given Qatar advance notice?
That's correct.
Yeah, right.
That's correct. It was advance notice. It was symbolic so they can go back to their people. We don't take anything, and then come to the table. So it's either going to be a negotiation or a regime change. We don't know yet. But what we do know is this is very, very constructive for the region. This has been a long time coming. They were completely decimated. It was completely by surprise over the weekend. There was no ambiguity about the message. You will not have nuclear weapons, and it would take them so long and so much money to rebuild. So the market loves this, and the Saudis are going to continue to pump. The Russians are going to continue to pump to avoid sanctions. So oil prices stay low. That's the key thing for President Trump. That keeps inflation lowered, so we can get some of these tax cuts done, and we can deal with the big beautiful bill.
Ben, thank you. Appreciate it. Tom, very quickly, I just want your take here. This big, beautiful bill, the tax bill. I'm just curious, as a money manager, as a guy who has to think through what to buy and what to sell, how do you think through that?
Yeah, I think, number one, what's underreported is what the bill unfunds. And if you look at what it unfunds, and a lot of climate stuff is taken out, which is why Elon Musk wasn't happy with the bill, it's more responsible than advertised. It's not perfect. The only way we're going to get out of 120% debt to GDP is through growth. And we need tax cuts. We need deregulation. That is happening. And things are constructive. I love the low bar that is set going into earnings season. They took down earnings from 9.3% earnings growth to 4.9. So there's a lot of global liquidity. People wonder, why have international stocks outperformed? Money goes where it's treated best. There are 15 cuts around the world last month alone, okay, which is the biggest amount since during COVID. And zero from the U.S. So I think what you're going to see is you start to see some division here. Waller, You had Goolsbee today. You had Bowman today, now coming out kind of against Powell. I think the Fed wants to be more dovish. I think global M2 money supply, you look, is at record highs after flatlining since 2022. So there's a lot to be constructive about here. A lot of growth coming, a lot of deregulatory policies. Animal spirits want to go. So we got through kind of the worst of the tariff. We got through the kind of the worst of the geopolitical here over the weekend. Now it's like companies are on track. Animal spirits are coming back.
Julie, bring me back here. I'm listening. Agree with that? Is it a shrug for the market, the tax bill?
I think at this point, I think Julie's right. And as far as being optimistic, 70% of the time you're right. That's what happens with the stock market. Haven't met too many wealthy pessimists, so it's paid to look at the bright side of things. And you know what? Based on the data right now, there's a lot to be constructive about.
All right, company's robo-taxi service yesterday. Electric vehicle manufacturer launching the program with 20 cars that will still be occupied by employees to monitor, with each ride costing a flat fee of $4.20. CEO Elon Musk says that Tesla will likely expand the service based on its performance. Tom, what do you make of it?
Well, it's like a magician. Look over here. It's the illusion. I mean, the car business has deteriorated since his involvement in politics. However, if he's right, I just saw a quote from him. We expect hundreds of thousands of robo-taxis, if not millions, by the end of the year. That is a bold statement. If he gets anywhere close to it, maybe today's move is an underestimation. However, if we look at the car business, that's another story. And I think it's a trade-off. You're always betting when you pay the valuation that you do for Tesla. You're always betting on the man. And he's delivered for many, many years, and the followers want to continue to bet on him. So this is a step in the right direction. Robo-taxis could be game-changing, but it remains to be seen. If you have drivers in the car, it's not a robo-taxi.
Julie, bring you in. Halting a sales slide in the U.S. They talk about an aging lineup, model delays, pricing blunders, but what do you make of it?
I think rule number one is they should probably get rid of the other 12 managers. Then they could be lean and more efficient. Look, that's a tough business. We are in the, we have a business that supplies the sealing systems around the windows, the fluid transfer systems. I'd rather be an arms dealer, because what's going to happen is Besson's going to be successful with bringing rates down modestly this summer. That's going to bring down financing rates for cars, but it's going to be a race to the bottom. There's going to be a huge amount of supply. Their margins are going to continue to go down, the OEMs. The suppliers of the parts are going to be the ones that do well, because we've got average car on the road is 13.5 years. There's a huge pent-up replacement cycle. We just need to see the incentives, and we need to see the financing rates come down, and they're going to start to do huge, huge volumes. The question is, what are the margins of the Stellantis, the Ford, and the GM going to be? I don't want to be in that business.
All right, Julie, bringing you back. What's a big, noisy universe of stocks out there? Welcome to Goodbye or Goodbye. Our goal here to help cut through that noise, to navigate the best moves for your portfolio. Today, we're dissecting valuations, and I'm here with Tom Hayes, Great Hill Capital Chairman and Managing Member. You're bullish on Albemarle, Tom, so that's where we're going to start. We're going to go through the reasons why you like this name, which, by the way, it's had a rough, year to date. It's been kind of rough, but we're going to walk through why you say this one's a buy. So let's go through the points. First point, huge operating leverage.
Yeah, this is a big deal. So they're a lithium producer. They're the lowest cost. They're one of the largest lithium producers. So right now, lithium prices go in 5 to 8 year cycles. We're at the trough of the cycle. It kind of fell into the EV narrative that people don't want EVs anymore, but that's really not the story here. As the price turns, as it does every 5 to 8 years, even pre-EVs, we're talking 40 years, this has been going every 5 to 8 years, the cycle. The amount of operating leverage that Albemarle has to benefit as prices go up is astounding. And in the short term, they've got ample liquidity to ride through that trough, while their competitors will fall away at the wayside.
All right, second reason you say this one's a buy, demand growth.
Yeah, so the EV story is predominantly a China story. China has 60% of the EV market. They're growing in leaps and bounds. This is an unnatural, subsidized market that's going to continue. It's an initiative of the government. U.S., by contrast, only has 10% of the EV market. But that's not the source of the actual growth for lithium. It is energy storage systems, okay? That's expected to have demand from 1.2 million metric tons to 3.2 million metric tons by 2030. Albemarle is going to be the key beneficiary of that growth.
Final reason you say to pile into this one, dividend aristocrat.
Yeah, they've been raising the dividend every single year for 30 years plus. That makes them a dividend aristocrat. Stable balance sheet, $3.1 billion of liquidity. The market is expected to rebalance by 2026. And when they rebalance, it's the stock is down materially. We do turnarounds. My nickname is Turnaround Tom. So this is a 3 to 5 year play. This stock from current levels, it's trading around $55, $60, could go back up to $150 once the cycle returns and the operating leverage benefits. And you're locking in a yield at current low levels, so you're getting a high yield on the stock. It's below 3%, but not only will you lock in that high yield, but they'll continue to increase the dividend every single year, similar to what Buffett did with Coca-Cola in 1989, and he gets more dividends than his basis every single year, 20, 30 years later.
All right, turn around, Tom, but here's the thing. So viewers are watching this right now. Before they commit capital, what are some downside risks they need to think about here?
Yeah, I think the biggest downside risk would be if the Chinese government did an about-face and they said, we're no longer going to subsidize our green initiative. It's a very low probability, but some of that demand is from the unnatural subsidies in that government initiative. That's going to continue, and we think it's part of their domestic consumption plan for 2030. They want 70% internal domestic consumption. So I don't see that happening, but that would be a risk.
All right, so that's your buy. Let's move to the name you don't like, and I like this one. I like this one because people have very strong feelings about it. Palantir, not a fan. Let's go through these reasons as well. Stocks overvalued.
Yeah, look, it's $324 billion market cap on $3.9 billion of sales, 83 times sales, 200-something times earnings. So you're effectively, look, if you believe in Palantir, and they certainly do have a defensible moat, they're going to do great things. The question is, how much of those great things that they're going to do over the next decade are you already paying for today? Current valuations, you would have to grow revenue at a 50% compound annual growth rate for the next 10 years to justify the current valuation.
All right, bullet point number 2. So it's too rich, the second reason.
Yeah, so 50% of the stock, a little more than that, is owned by retail investors. If that sentiment turns, like we saw with the meme stocks, whether it was AMC, high valuation, not really on the basis of current fundamentals, GameStop, et cetera, when they fall fast. When they exit all at once, so you have some risk there.
And a final point here, the reason you'd say avoid it, aggressive competition.
Yeah, there's no question. You've got Databricks, you've got Microsoft, you've got AWS, you've got all these companies coming into the arena. I would say another red flag has been the insider selling. $125 million in the last 30 days alone. The chief technology officer is selling like his pants are on fire. I mean, unless the guy wants to buy a $120 million house, I don't know what he needs all that cash for. So it tells me maybe it's gotten a little ahead of itself. The other thing I don't like is that they've diluted their owners and increased the share count by 4x over the last 6 years. So even if they continue to do that, if they keep issuing stocks to management in abundant amounts, what is your slice of the pie going to look like if you buy today and they 4x the share count again over the next 5 to 6 years?
Now, before turnaround, Tom, I let you go.
Yeah.
The last thing I need to know, though, where could you be wrong? What are some upside risks I need to think about?
I think the biggest risk, they certainly have a quality product. It's a defensible product. They have a moat around their product. The biggest risk is if the Defense Department decided to double government spending on defense, which, given the budget talks, given the initiative of this administration, is probably a lower probability, but not a non-existent probability with everything we've seen over the weekend. Nothing is out of the question, in which case Palantir would be a beneficiary. Government spending would go up. Their contracts would probably go up.
And we should know the stock has been a monster, Tom.
Yeah.
It's up about 85% this year already. It was up around, last I checked, 480% over the past 12 months. What a run. But there it is. Portfolio recommendations, buy Albemarle, avoid Palantir. Thank you so much, Tom. Thank you for the viewers as well for watching Goodbye or Goodbye. More market domination right on their side. And Tom Hayes still here with me. Thoughts on all this, Tom, as we're counting down to the close here?
Yeah, well, first and foremost, every time there's a conflict in the Middle East, everyone's worried about closing the Strait of Hormuz. It's never happened. Not even
Which is
during
remarkable, by the way, that it has never happened. It's never closed.
Markets climb a wall of worry. Yeah. You know, I looked at the most recent Bank of America Global Fund Manager survey, the sophisticated, $500 billion, 222 managers. They are still nearly as pessimistic as they were during the COVID lows, nearly as pessimistic as they were during the great financial crisis. I mean,
those are the pros. What about the retail investors?
Well, look, retail investors, oddly enough, have been right since COVID. They've been buying all the dips when the institutions have been hiding under the table, and they've been making all the money. And I think that trend is going to persist. With sentiment like this, markets don't top when sentiment is that pessimistic. And that's why I think we're going to push to new highs before the end of the summer. Then we'll probably get into some fall normal chop, normal volatility before the end of the year rally. But it's earnings driven. I love they've brought the bar down low for Q2 earnings. 4.9%, easy to step over. You don't even have to jump. Market's going to like that. Global liquidity, M2 money supply, 15 central bank cuts around the world. Fed, by the way, now a little bit of dissension. 3, Bowman, Goolsbee, Waller looking for cuts instead of remaining too restrictive like Powell has been talking about. They probably lay that out in Jackson Hole. So what's not to love? There's a lot of good things. Look, we just went through the end of the world tariff war. We just went through the end of the world, a possible World War III type of situation. And these companies keep chugging along. GDP now estimates.
What worries you? What would be on your list of worries on your radar? Downside risks.
Downside risk would be if President Trump didn't like how quickly the tariff negotiations were going, and he did the hard stop on July 9th, and we're back to where we were in April. The probability is that very, very low. We've got an election coming up in next year. I don't think he's going to do that. He'll threaten it, so you'll have a little bit of volatility on the way up. But on balance, it's continues to be time to be constructive, but selectively constructive. And that is, I think, which Ed Yardeni referenced, is the unmagnificent 493 trading at 18 times. There's a tremendous amount of opportunity and underexposure in those stocks.
Stay selectively constructive.
That's right.
Line. Thank you, Tom. While we're wrapping up, Tom Hayes, Great Hill Capital Chairman and Managing Member, still with me. Thoughts on today's moves? What do you make of it, Tom?
Well, you said selectively constructive. I'll tell you what's really interesting today. Small caps outperform tech, outperform the S&P 500.
What do you make of that?
I make it's risk on. People are playing the catch-up trade. You got some short covering today. Record short interest in small caps right now. I think that's going to be a meaningful trade for the second half of this year as people realize, wait, they sold in the hole. Record $1 trillion of equity sold at the beginning of April. They've continued to have been forced in. Now they're like, the market's gotten away from me. How am I going to catch up on performance? The only way you can catch up is to buy the laggards. So you want to be buying small caps. Certainly some exposure to international, even though international has outperformed. And we're seeing that type of thing on these risk-on days. We're seeing the short covering. The shorts become the first buyers, and then you get this positive constructive cycle. And if you want some valuation relief, small caps is the place to find it. And mid caps, you started to see flows come into mid caps. So it's really interesting to see that today. I'm paying close attention to that.
Jared, I want to bring you in here. All right, Tom, back to you. Actually, I want to get your thoughts as well on the Fed, because as I was talking there with Mike, you heard from Powell last week.
Yep.
And Powell saying, listen, I got to see how this tariff inflation is going to play out.
Yeah.
I got to see who's going to pay for it. Is it going to be Tom and Josh? Is it going to be sellers and producers, or some combination? And the message should be, I'm not in any rush to cut, but I'm curious what you're expecting this year.
Well, I thought they were supposed to be data dependent. It sounds to me like he's being prediction dependent, because he is predicting that inflation is coming in the coming months. And in the meantime, he's 200 basis points too restrictive. And who has to foot that $600 billion of extra interest expense? You and I do as the taxpayer.
Is it your opinion they should be cutting now?
I think they should have gone 25 basis points this month. Obviously, there was no probability of them doing so. But now you start to see some of these people dissent. Okay, 3 people now in the last few days, Goolsbee, Waller, and Bowman. He's got to move, because we got to refinance, and millennials, which is 72 million people trying to start a family, family formation, mortgage rates at 7.25%, 7%. It's holding up home builders. They're not risking that you're seeing in building permits. It's time to go. You know, it's much easier if he's right about his predictions, which, by the way, he's got real GDP in the SEP at 1.4. If he believes his own predictions, he should be cutting 50 basis points, not saying I'm predicting inflation is going to go up. It's a one-time tax, just like Mike said. It's time to go. So they'll set the stage. He'll push it off another couple months, and he'll have his meeting in Jackson Hole, and that's when he'll lay it out. And we'll get 2 cuts, which is Goldilocks, because we don't want more than 2 cuts like Mike alluded to, because that implies bad things.
You should be cutting. You have powerful people in your corner, of course, the president, I believe.
I think so.
Around Tom's corner. Thank you, sir.
Thank you.
Tom, you were listening closely. You're a portfolio manager. You've got to decide what to buy and what to sell. What did you make of what you heard there?
I liked what Brian said. Brian, what do you think is going to turn around the volumes at CarMax? Is this just an interest rate play? Because you choose industry leaders. I do turnarounds. My name is Turnaround Tom. So we'll talk about Advanced Auto Parts outside. I'm sure you have a lot to say about that. But Shane O'Kelly, we're making a bet on Shane. We're going to have our little niche business just with the markets where we're 1 and 2 because O'Reilly's decimated us everywhere else. But is that how you think about CarMax? Because the average car on the road is 13.5 years. The volume should be booming, right? I mean, and you're also hedged because if people are going to drive it to 15 years, you're going to get the O'Reilly business. But what moves the needle on that one?
Well, as you're familiar, you know, the transaction volumes in both used cars and new cars have been slowed by the high retail prices.
Big thanks to Thomas Hayes, Great Hill Capital Chairman, Managing Member, for hanging out with me today for the show. Final thoughts? I'm selectively constructive. I like that.
Selectively. Phrase. Look, if we look at earnings, by Q1 of 2026, Mag 7 is going to decelerate from 27% earnings growth in the first quarter of this year to 10.2 in the first quarter next year. Unmagnificent 493 accelerating from negative last year to 10.3% first quarter next year. So you're paying lower multiple for more earnings growth in the 493. You're paying a higher multiple for declining earnings growth in the Mag 7. There's a lot of opportunities. You just got to look under the surface. And as we saw today, never bet against America.
Look under the hood. Tom, we'll leave it there. Thank you, sir. Appreciate it. That'll do it.
And we're back. And then on the Big Money Show, also for the full hour, as with Stu Varney, by the way, I want to thank him for putting me on as company, which means you're on the full hour, which is a big honor. And the full hour, want to thank Madison Murtaugh, who, by the way, is a swimmer. She swam at Penn State, producer and booker. Brian Brenberg, Jackie DeAngelis, Shel Cassoni, and Charlie Gasparino was on. It was fun to see Charlie. And we're going to listen in here.
But let's start with NATO. President Trump was very happy to announce that he got the other countries to pay up 5% of GDP. And so he's winning on multiple fronts here.
Yeah, it's a lot easier to go into those negotiations when you just dropped 30,000-pound bunker busters on Iran and was successful in quelling their nuclear ambitions. So I think it was very, very successful. I think President Trump has wanted this for a while. He's brought them along, and now he closed the deal as he's done over and over and over.
Charlie, you have covered Trump for many.
That we need more intelligence to make sure that we did obliterate those sites.
Well, I'll tell you, owning Boeing stocks, if you understand what those bunker busters do, these are not surface missiles.
No, I know.
They'd go deep down and
but remember, they've been planning for this for how many years?
Fair point. But they go 35 floors deep. President Trump was talking about these bunker busters, 30,000 pounds. They go down first.
Was there anybody in there while they were dropping the bombs?
After.
No, I know, but was there anybody in there while they were dropping the bombs?
We don't know.
We didn't give them notice, I'll tell you that.
They're not reporting that.
It's, Charlie, that's the tech sector. Higher, you can agree or disagree with me, jump in here.
Yeah, well, I think, look, it's not just NVIDIA, it's not just the AI players, it's the beneficiaries. You're going to see industrial companies become more productive. You're going to see companies across all sectors become more productive. I mean, when we talk about the roaring 2020s and the tailwinds that we have right now, whether it's the ceasefire, whether it's the trade deals, whether it's the big, beautiful bill, the permanent tax cuts coming, there's a lot of things to be constructive about. And what's really beautiful is sentiment is still so low. If you looked at the Bank of America Fund Manager survey last week, it was near COVID low levels. What does that mean? As more trade deals come out, as more good news.
Which part of the trade deals are good, though?
More
initial
forced
one
buyers.
or the putting the genie
Charlie,
back in the bottle?
we have a B block, and we will go into that in depth, my friend.
Okay.
We'll get you.
Always shepherding the cats. Thank you. Coming up, trade.
Hey, Tom, you seem pretty bullish on the trade deal front. Make your case.
Yeah, listen, the market participants now have confidence in this administration's level of kind of rational behavior when it comes to the economy and when it comes to markets. Look, we have an election next year. We pushed it to a certain level. But what people don't keep in mind, Trump always comes out with a huge ask. Okay, that's the way he negotiates. He kind of punches you in the face and then he offers you an ice pack and you're happy you got the ice pack. And that's basically what we're seeing with the negotiation here. What we have right now is still some $300 billion coming in from tariffs just at the 10% level. If he had started at 10%, where would we get? We'd have nothing. Okay, so he started big. 10% looks like a deal. And what we have to focus on is non-tariff barriers. He wants markets opened everywhere for U.S. businesses to expand. And I think that's going to be a core part that people are less focused on. They're focused on the 10%. They're focused on that. They're going to be pleasantly surprised by the amount of fairness in bilateral trade moving forward.
Okay, Charlie. Is anybody sober in Washington right now because they're spending like drunken sailors?
Yeah, it's out of control. There's no question about it. We got to get spending under control. But I'll tell you what, at 120% debt to GDP, the issue is not really spending because you can't austere your way down to 50% debt to GDP. The only way you're going to do it when you're this far past is growth. Okay, so we've got to extend these tax cuts. We got to continue with deregulation. The last time we had 120% debt to GDP was 1948. By 1958, we were at 53% debt to GDP. You know how we did it? We didn't cut spending. We grew massively above trend, and inflation ran a little bit above trend.
Half the world was destroyed because of World War II. We were the only
you had
game
rebuilding.
In town.
Yeah,
we were the only game in town. I mean, we have a different economy right now.
Yeah.
I think we're lucky when we get 3% growth right now.
Yeah.
Okay, so remember that. So you do have to have some austerity here, and there's no austerity in this. I mean,
but Cheryl, to answer your question, you're seeing the natives are getting restless at the Fed. 3 people came out against Powell. That 2% is costing us taxpayers. He's 2% too restrictive. That's costing us $600 billion a year in interest payments. You know who it's destroying? Is the millennials. 72 million people trying to start families, housing formation, family formation. Can't do it with 7%.
Based off the 10-year bond, not the.
Well, July's on the table.
Listen, Bessent can issue short term and buy in the long end of the curve, do an Operation Twist like 2012.
What he's been doing is exactly what Janet Yellen's been doing to artificially keep the 10-year. But you cannot finance long-term your long-term liabilities with short-term debt. It leads to bankruptcy.
Can I just say one thing? I mean, we've seen this playbook before in so many blue cities across the country. It doesn't work.
I was talking to a colleague a couple weeks ago when I was on my way to Dubai. He lives in Miami. He moved his hedge fund business down to Miami about when de Blasio was in. He goes, when I was your age, New York and London were the center of the world. Today, it's Miami and Dubai. And unless we change the policies, and what do those two jurisdictions have in common? Business-friendly policies, business-friendly regulations.
By the way, Detroit's
we're going to get more
nice
of the
right
same.
Now.
I gotta go.
I was there recently.
Thomas, thank you for being with us. We really appreciate it. It's always great to see you. Coming up.
And we're back. And then I had the pleasure to join Brad Smith today on Yahoo for 2 hours. We'll only give you the best clips. Want to thank Justin Oliver, Brad Smith, and Cheyenne Reed. We'll listen in now.
Just after the opening bell, we appreciate it. On Wall Street, strategists see AI and economic data replacing tariffs and the tax bill as the big focus for investors going forward. Barclays strategists expecting more gains for stocks with AI driving earnings. Joining me now, we've got Thomas Hayes, who is the Great Hill Capital Chairman and Managing Member. Thomas, great to have you here on set with us today.
Great to be with you, Brad.
Absolutely. I had to try and squeeze your question in with our previous guest, Dan Ives, but I got to know as well, since you are also very closely tracking this space in AI, how are you looking at AI and how it's playing into the broader market rally right now?
Yeah, look, I think Dan is spot on. The demand exceeds supply by 10 to 1, and that's the issue with NVIDIA right now. Their business model depends on the kindness of strangers. So Taiwan Semiconductor has limited their revenue growth each quarter to $4 billion because that's all they can fulfill. So for the next phase of NVIDIA's growth, you need to see those fabs get finished by Taiwan Semiconductor to increase capacity. And I think the dark horse that no one's paying attention to, you've seen a stealth rally in, Intel 45 miles an hour in the slow lane, 10% plus this week. And I think part of that is Lip-Bu is cutting staff. I think the other part is they're the only game in town with fabs at the 10-yard line ready to spike the football and the touchdown. There are chips being tested on their fabs. And I think if they can be a part of that supply solution to NVIDIA and others, that could be kind of a dark horse. So while you see maybe NVIDIA double, if Intel gets it right, it could be meaningful.
That also raises a similar question that we had brought up in our previous conversation with regard to how many of those chips will be able to be shipped to other parts of the world if so much of the money that's helped Intel get to this point has really been prioritized at bringing up and scaling up production here in the U.S.
Yeah, well, I think once they get that production set, I think the sky's the limit as far as global demand. And I don't think they need to be best in class. I think there's going to be so much unlimited demand that anyone that can produce, even second tier.
That's a weird call to say, hey, just be mediocre in class.
By the way, that's my base case with Intel, is they are the leader of mediocre chips. And by the way, as they bring this capacity online with Lip-Bu, he did unbelievable things at Cadence Designs. That was a multi-bagger. No one's better. He's going to fix it. They're going to be part of the solution. It's going to help NVIDIA. It's going to help Intel, et cetera. And it's going to help boring, normal businesses that implement AI, which Dan alluded to, which is going to be huge, which no one's looking at right now. Right now, you think AI, you think Mag 7, you think Palantir, you think NVIDIA, but the big beneficiaries are also going to be real businesses.
What needs to continue to take place or transpire within business spending towards AI to really continue to allow the AI trade to keep its foothold on this market and be the kind of core barometer of the investment psyche, if you will?
Yeah, it's really interesting because you see the Mag 7, and there's like a good news is they're benefiting from the AI trade. The bad news is their earnings growth is collapsing because they are doing all this CapEx. So Q1 of this year, earnings growth in Mag 7 was 27%. Q1 of next year, 2026, earnings growth is going to be 10.2, but the multiples have not really compressed. No. Then you take the unmagnificent 493, all the boring companies that are going to benefit from these technologies in terms of implementation, their earnings growth was negative. It's going to be 10.3%, and the multiple is meaningfully lower. So I think there's a lot of unexpected AI opportunities. If you take Brad Jacobs, for instance, he does all these roll-ups. QXO, where he buys boring businesses, building supply companies, et cetera, and he goes in and he doubles EBITDA with technology. He's a huge implementer of these technologies in boring businesses. GXO Logistics, they're one of the first businesses using humanoid robots to help move the stuff in the different distribution centers and warehouses. So it's pretty wild.
I've got Brad Jacobs' book on my desk. Thank you for sending that, Brad, by the way, from one Brad to another. Just lastly on this topic here, because we're going to discuss a range of topics throughout the morning here, but as you think through the leaders of the tech rally right now versus the rotation that we could see, names that have been underappreciated, where are those parts of that trade?
Yeah, I think, the market's going to continue to push higher for the next 4 weeks. Why? Partially because of global liquidity is back at an all-time high, partially because earnings expectations are really low. They've taken them down from 9.3% to 4.9%. So that's going to drive the bus. Mag 7 is kind of back up to the top of the range despite earnings growth deceleration. So I do think as you kind of stabilize after we make those new highs and everyone gets euphoric and tech's got to push it up because of the weight in the indices, I think that second half of the year where you're going to benefit is the unmagnificent 493. But it's interesting. I'm looking at today, small caps are outperforming the NASDAQ. So Russell 2000 outperforming the NASDAQ, outperforming the Dow Jones, outperforming the S&P 500. that is the small cap index is the most shorted in history right now. And these are the type of companies that benefit from these technologies. And I think you're going to see the back half a big surprise in the 493 in small caps, in companies that will be beneficiaries of the great things that the NVIDIAs of the world are providing.
All right, Thomas, we got a lot more to discuss here. You're with us all morning. We've got much more on Catalyst as well here. Markets action, of course, some of your top picks for the round 2 of the NBA draft as well. If you want, you're watching Market Catalyst. We got a lot to get to. Stay tuned. Still here with me, we've got Thomas Hayes, Great Hill Capital Chairman and Managing Member here. So, as we think about the SLR, of course, as we're hearing from Fed Chair Jay Powell, who was commenting on it during his 2-day stint on Capitol Hill, both discussing with the House Financial Services Committee and then additionally with the Senate yesterday here, this question came up. The SLR was supposed to act as a backstop to risk-based capital requirements. Too often, the SLR acts as a binding requirement for U.S. banks. They went on to ask, would you agree that adjusting the SLR would free up capital for banks to invest more in treasury markets and other low-risk assets that would be beneficial to families and businesses across the country? And on net, he agreed. Yeah. So what is the significance of that? What should banks expect from this point forward?
Yeah. This is the biggest news of the summer, okay, and maybe of 2025. Effectively, what it's going to do is enable banks to own a ton of treasuries. They're not going to have to post capital against it. So they can do that. They can get the yield. And banks' preference, they tend to buy on the short end of the curve. So in terms of mortgage rates, how does that really help? And that's the argument people make. Well, what's the difference if Powell cuts because the 10-year yield dictates the mortgage rates? What happens is they can issue short-term and do an operation twist like they did in 2012. Besson can do it at the Treasury and buy in the longer end of the curve, which could bring down the 10-year yield by 30 to 70 basis points. If that happens, you could see a 30-year fixed rate mortgage by the end of this year in the high fives, below 6%. Once that happens, the demand for housing is going to be off the charts because basically Powell has delayed the dreams of 72 million millennials by artificially holding rates 200 basis points above inflation, highly restrictive, and you see the average age of a new home purchase has gone up so much since Powell has been.
It's 38 now.
It's 38, and that becomes late to start a family. It becomes late to have kids. So a whole generation has been hurt by wrong-minded policy. And if and when Trump announces a shadow Fed chair, Powell immediately becomes a lame duck for the rest of his term because the market will start to price in. Let's just say it's Kevin Hassett.
Sure.
Very dovish. The market will begin to price in 200 basis points of cuts in 2026 immediately. Powell will have zero power from that point forward. So when he says the end of September, he's basically saying, time to move, or I'm going to go with this. You got to move in July, or you got to move in September, or I'm announcing the shadow Fed, and you're effectively out, even if you want to stay in the chair for 6 more months.
That's really interesting. Thomas, you're sticking with us for much more to break down throughout this hour. And next, all of our markets action ahead. Stay tuned. You're watching Market Catalysts. Kratos. We'll get the pronunciation there. Kratos Acuity and McCormick. First up, Kratos Defense and Security Solutions. Not one we talk about all the time, but they are offering nearly 13 million shares of its common stock today, worth roughly $500 million. The technology company plans to use the proceeds for expansion of its existing national security programs, new acquisitions, and to pay down debt and expenses. Shares are falling after the announcement. I want to bring in Thomas Hayes, who is the Great Hill Capital Chairman and Managing Member here. Shares right now, they're lower by about 1.8% here. Where does this company fit within the broader kind of defense mindset among investors from what you've seen?
Yeah, well, the bad news is it's dilutive, so the shares are down a little bit. The good news is they couldn't have timed it any better, which is what bankers tend to do. 5% of GDP spending coming out of NATO for all these nations, so good time to go out with an equity offering for a defense company. Unmanned systems, satellite business, missile defense, it's kind of the sweet spot of what everyone's been focused on this week. They raised $500 million. They can grow, they can expand, and they're going to benefit from the trends.
Yeah, it seems like Benchmark raising its price target to $48 from $40. They maintain their buy rating on this stock here, and we'll see exactly what this means in terms of how that funding and how that capital gets infused into the business and put to work as well for some of those scaling efforts here. We're also tracking Acuity this morning. Acuity reporting third quarter estimates that beat the street's estimates, both the top and bottom lines here. The electrical equipment producer saw revenue jump over 20% year over year. The company, which makes smart lighting fixtures, saw sales top $1 billion in the latest quarter. And shares, they're ripping to the upside right now by about 6% here, sending the shares up above $305 now a share right now, intraday here, Thomas.
Yeah, no question. I mean, this is a preview of coming attractions. I think we're going into this Q2 earnings season with very low expectations. Sentiment is still in the gutter. If you remember the Bank of America Fund Manager survey from last week,
yes,
institutional managers have lower sentiment than they did during the COVID lows, and even going back to the Great Financial. It's starting to come off the bottom, but you don't top in markets when sentiment is that low among 222 managers they surveyed with $500 billion of assets. So they're playing catch up, and companies like Acuity, you deliver the numbers, you're going to get bid up.
Yeah, it was really interesting. The chairman, president, and CEO, Neil Ashe, saying that we grew net sales, expanded our adjusted operating profit and adjusted operating profit margin, and increased their adjusted diluted earnings per share, generated strong cash flow, allocated capital effectively. That kind of hits on all the check boxes that investors are looking for going into this report.
So we want to see these beats, and we want to see the raised guidance, and that's going to continue to be the theme in coming weeks.
Absolutely. And finally here, McCormick beating expectations for its second quarter. McCormick also reiterated its full year 2025 guidance, with the company's CEO saying they have, quote, robust plans to mitigate current tariff-related costs. That's despite several potential headwinds for the consumer staple market, including dietary changes, trade uncertainty, and inflation. You're taking a look at shares of McCormick, higher by about 5.3% on the back of these results. We were talking in the break about how much I take pride in my own seasonings and the cooking of the proteins necessarily. You got to have a little flavor in there.
Yeah, there's no question about it. And I'm looking at, I look at sectors. They call me turnaround Tom. I like to buy businesses that are out of favor. I'm looking at consumer staples and defensives, and you're seeing a lot in that group, whether it's Kraft Heinz, there was some recent news out, General Mills, Hormel. These are all kind of left for dead stock. So, you're seeing McCormick's earnings. This might be a preview of coming attractions for some of those that have kind of been unfavored of late or unseasoned of late. And maybe coming through this earnings season, they start to get interesting, particularly when volatility picks up in the fall and money moves a little bit more defensively. So keep your eye on consumer staples, packaged products, and the like.
If it wasn't so hot outside, I'd be ready to go outside and season with some McCormick, but it's pretty toasty, so I don't need to be by the grill. Yeah. Thomas, stick around. Right. We've got more here. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. All your markets action straight ahead. Stay tuned. You're watching Market Catalyst. Into the conversation, because you did not mince words on the Fed's role within this earlier. So given what we're seeing transpire within the housing market right now, to what extent is that the Fed? To what extent is that also just a byproduct of people needing to figure out, okay, how much home can they afford, the affordability issue, and then the number of people that are also just still sitting on their homes because they got locked in at very good rates?
Well, that's the problem. I mean, you run rates 200 basis points above inflation, you have unintended consequences. Number one, unaffordability for the 72 millennials who want to start a family. And number two is all these baby boomers that want to get out of their equity, but they're not going to sell a $2 million house, take out $1 million equity, and then go into a 7% mortgage when they're in a 3% mortgage. So I think the name of the game this summer is that the SLR is going to bring down the 10-year Treasury 30 to 70 basis points. You're going to see 30-year fixed rate go below 6%. And at that level, I think you're going to see a huge amount of inventory. And then you look at the home builders, okay? Who wants to risk capital building massive amounts of starter homes at 7% and have them sit in inventory? They can't make the investment. And this is the unintended consequence of one guy trying to protect his legacy and not be Arthur Burns. And the conditions of the economy are not, and the demographics are nothing like they were in the 70s. So they've got to move. And if they don't move, we're going to get a shadow Fed, and that's going to move the market. And he can just sit in the desk for 7 months until he leaves.
I mean, it's not fun being Fed Chair Jerome Powell, because you are the face of the decisions that a body of people and Fed governors make within that committee.
You know what? In fairness, you had autopilot in December 2018. You remember that crashed the S&P 20% until Mnuchin came in and fixed it. You had transitory. So listen, I mean, his legacy is his legacy. He's got a chance to do it right and go out a winner like Seinfeld, and he's missing the boat. So he's got July. Let's see what happens in the next few weeks, and he can be an absolute champion and help 72 million millennials get their families started and get in new houses, help the home builders. And by the way, housing is 16.2% of GDP. You know how many jobs that creates that are being held up by this artificially restrictive environment?
Claire, last word goes to you. What does this mean for the home builders? What are we hearing on the stronger Treasury auctions that took place the week prior to that as well? So what is the larger implications that traders and investors are thinking through in their mindset?
The most important thing here is the tax cuts. Okay, so we've gone from bombing and tariffs to growth and deregulation. And growth is a function of the tax cuts. As Brett is alluding to, it's a little bit stimulative here, and you can kind of talk a little bit more about that in detail. I would just say, so that's critical. So, you know, if tax rates were to go up, it's going to impact earnings. It's going to have a negative impact on the economy, hiring, growth, the whole thing. So that's not going to happen. We've got the Treasury doing what they're doing with the SLR. We've got the tax cuts coming in and animal spirits coming back because management can plan. They can start to forecast, kind of understand the rules, whereas the first half of the year, everyone was uncertain. So, Brett, how do you handicap this getting done by July 4th, or no vacation, no one goes home, locking them in a room? You've been through this process many times. Does this look any different, or is this just the normal back and forth and eventually they get something done?
Yeah, I mean, it does look like the normal process of back and forth. It's just that they are
the next Fed chair could be might look like in terms of commentary that we could hear from that person in a almost shadow Fed, because that person wouldn't be going in until May 2026, but we'd get more inclination through what they're willing to talk about openly and publicly, and policy could be one of those areas where the Fed typically will not comment on that and try to be apolitical, yet you would have someone who would be put forward in their name and have pretty much open season to say whatever they want leading up to that point.
I think it's less what they say and more who they are.
Yeah.
So, you know, if Hassett's the guy, I think the market starts to discount that pretty darn quick, and that's going to have long-term implications in terms of refinancing the debt, the cost of the debt, et cetera. But I have one last question for you, Brett. What do you think, as the bill stands right now, what do you think that adds or detracts from GDP in the short term over the next 12 months? If it went through today as is, incremental benefit or drag?
Yeah, it would be about 40 basis points positive.
Wow.
You know, depending on where you put some of the scoring. But yeah, from a deficit, from a fiscal impulse perspective, 30 to 40 basis points positive, for sure, relative to trend. And so, you know, that's, if the Fed's trend is 1.8, you know, you're looking at 2.1. Our forecast is around 2% next year. But again, a lot remains to be seen. Fed chair, that's a whole different.
That's another hour.
I think the next Fed chair, you know, you have to be careful, as you alluded to. You know, if the market loses confidence that the Fed is independent, then your long end is going to be a serious problem, and it doesn't matter how much you cut the front end.
Brett, thanks so much for taking the time here. Joining us in studio, Thomas, thanks for staying with us for the conversation as well. You stick around. We've got much more ahead. The brands that they own. I mean, this is a company we're talking about that not only has the swoosh, they also have, of course, as you were mentioning, this new partnership with Skims. They've been leading into some of those collaborations. And then additionally, they've got Jordan Brand, which they've leaned into. Oh yeah, don't forget Converse as well, where they just had one of their stars win the NBA Finals. So all of these things considered here, they've got different levers that they can pull. And my goodness, I don't know if you had the Air Jordan 1s when they first came out, Thomas, but they're about to hit Jordan 40 right now.
Oh my goodness,
wow. Throughout my feed.
Listen, the most important thing they've got is Scotty Scheffler. You know it, I know it, everyone knows it. I love a great turnaround story. You know, you were going through all those negative points, Brooke, and all the analysts are so negative in the whole. You know,
trying to get past this.
Yeah, it reminds me of, other than that, how was the play, Mrs. Lincoln? But I love when the market's so pessimistic. They did screw their wholesalers to say it. They've got to rebuild those relationships. They're going to. You know, my nickname on the street is Turnaround Tom. I would love to buy a lot of Nike. I should be buying a lot of Nike at these levels. I really hope it goes down a lot after earnings, and maybe that'll be a new position. But, you know, I'm betting on another turnaround specialist, Bracken Darrell, over at VF Corp. He's got his work cut out for him. He's going to turn that business. So I don't know if I want to be overexposed, but man, fresh capital If this thing is lower, I'd probably be inclined to buy it with a 3 to 5 year view.
Are you talking about a low below what we've already seen? I think they struck 52 earlier this year.
Yeah, I'd love to see it approach that level. If it did, I'd be inclined. Like, at some point, you got to stop watching and step into the ring. I think the turnaround is going to be slower than the optimists think, but I think it's going to be certain. This is a company of winners. They hire the best. They get the best athletes using their stuff. They got to get back to winning. And they will get back to winning, and they've got to rebuild those relationships. So maybe we'll see some signs of that tonight. I don't anticipate it's going to flush out to the level that would attract me. It probably, we're at the stage where you're going to see some good news would be my expectation, because expectations are so darn low.
Yeah, and I do want to point out,
I still have Thomas Hayes, Great Hill Capital Chairman and Managing Member, with me here. And as we're taking a look at shares of BlackRock, they're up by about 1% here on the day. Is this really expected to move the dial longer term here? Why does it make sense for BlackRock to do this?
Yeah, I think they're doing it because they can. Okay, it's a huge market. The idea is to democratize private equity, but you see they follow the trends. First Larry Fink said Bitcoin was no good, and then the thing took off, and then he started offering it to the public with the ETFs, et cetera. So I do think that there's going to be a place. This is going to be promoted by a lot of financial advisors. This is going to be a part of the portfolio. The beauty of private equity and private credit, which have become so popular, is that you have no mark to market. So it's perceived low volatility because they mark the assets, what we used to say during the great financial crisis, mark to make believe or mark to whatever. And you never really see a mark until the asset is worth zero, until it's fully marked down. So in a bull market like this, everything's marked up, everyone's happy, there's no volatility, you don't see that daily volatility. Retail loves that. Institutional consultants love not having the volatility. They love their Sharpe ratios when they come in, the 25-year-old with their clipboard. But when you take the marks are big. So I think there's going to be a place for this in a lot of 401ks, and for a lot of retail investors are going to try their hand. But as you move into a recessionary type of period, these are the assets that you want to be careful of.
Yeah, I was taking a look at one of the charts from Torsten Slok, Apollo chief economist, saying private equity as a percentage of public equity market, 2003, 3.8%. 2024, 8.8%. That's some of the growth here that we've seen. Tom, it's been great to have you here on set with us. Thomas Hayes, who is of Great Hill Capital, and taking some time here in New York with us.
Thank you so much. Thanks for having me.
That's it for Market Catalyst, everyone. I'm Brad Smith. Thank you for watching. We've got more Yahoo.
And we're back. And then I want to thank Alexander Osipovich for including me in his article on the Wall Street Journal. And finally, guess who is on CNBC this morning is Alex Chris from PayPal. They teamed up with the Big 10 and Big 12 to enable payments to student athletes. Wait till you hear this interview. We're going to listen in now.
Are there exactly 22 teams? Is that
more?
That's like the S&P 500. Yeah. To enable college athletic departments to pay their student athletes directly through the financial platform. This comes after the landmark June 6th court ruling that allows schools to directly compensate student athletes starting on July 4th or July 1st. July 4th just comes out, doesn't it? Joining us now to make the announcement first on CNBC, PayPal CEO Alex Chris and Big 12 Commissioner Brett Yormack, and Venmo's involved. I want to go back to college and get involved.
And be an athlete.
Yeah. Oh, that's right. You have to be an athlete. That cuts me out. Who wants to talk about how this came together?
I guess I'll start.
Okay.
First of all, thanks for having us.
You're welcome.
And I'll also start by saying there's never been a better time than right now for collegiate athletics, for all the right reasons. And there was a landmark settlement recently where for the first time starting in July 1, we'll be revenue sharing with our student athletes. And it does usher in a new age for collegiate athletics and our student athletes, and we're incredibly excited about it. Over the last 14 months, we've been on an incredible journey with PayPal, trying to find out where they could enter the ecosystem. And with RevShare and how ubiquitous PayPal and Venmo are on campuses and in collegiate athletics lives of our student athletes, it made incredible sense to have them partner with us as we pay our student athletes. When you think about PayPal and Venmo, the first and second most popular mobile payment apps in the U.S. There's 400 million customers globally when you think of consumers and merchants. So it just made so much sense given how they already infuse campus life. I was given a number the other day. There's 19.8 million student athletes across the country, and almost half currently use Venmo. And we needed a platform and a partner that was safe and reliable. And we found it with PayPal and Venmo. And Alex, I want to thank you and your entire team for all your hard work and for being on this journey with us. And it's a great day today for the Big 12, our student athletes, our campuses, the families of our student athletes. So thank you so much.
Well, I appreciate it. And again, tremendous partnership. And as you said, this is now an opportunity to distribute funds to students, but that's not something that schools know how to do, but it's something that PayPal does every day. And so our ability to distribute funds, our ability to now give students in the wallet that they use every day, right? Again, over half of college students are already using Venmo.
You know, I didn't think about it, though. It probably would have been an administrative nightmare for each of these schools to figure out how to pay these students.
This is what we do. And so our ability to move money, distribute these funds, not only the rev share, but then ultimately NIL deals as well. And then, this money is going into wallets that college students use every day. It's what their parents are putting money in for. It's what they're splitting the pizza at lunch with their teammates for. And they'll soon be able to make payments on their tuition as well.
How does this work? Do you pay them to do these services, or is this like a branding opportunity for you to be able to say that you're doing this?
It's a fully integrated partnership that benefits, obviously, the brand of PayPal and Venmo, but also the conferences. They're not a vendor. They're a true partner, and they will be in the ecosystem. And today, obviously, we're announcing, conference participation. But I would imagine that over time, this partnership will be infused throughout campuses all across the country.
So that means you're not paying them? It's a partnership and they get something out of it too?
What's that?
You're not paying them to do it?
No, we're not paying them.
No, and think about the partnership
where you get the branding.
And on top of that, so think about the branding. Not only is this for college students on campus, but think of all the alumni that have come to these amazing Big 12 schools. We'll be offering Venmo debit cards.
Just for the student athletes, or is that for
this is for anyone. For anyone on campus, any alumni that can come in and sign up.
Didn't you?
Absolutely.
That's why you asked.
Colorado, they're right there for you. We've got them for every one of the schools to be able to allow a student to be able to come in, an alumni to be able to come in. This is great branding for us. And again, this is the financial instrument for the next generation.
And we even have one at the conference level, which we're excited about. But it's a great day for the student athletes, and I am sure other conferences are going to embrace this opportunity. I was told last night the ACC is up next, so you're going to see this program roll out across campuses throughout this country, and I think it's the right thing to do. And again,
did you go to them, or did they come to you?
Well, that's a great question. When I came on board at the Big 12, I wanted to try to create some meaningful strategic partnerships that could integrate what the schools are doing with the conference and go into the marketplace with a real good business solution. And we started talking 14 months ago. We weren't intending to land where we did today, but it's a great brand. Alex had just taken over. They were looking to reimagine and reinvent their business, no different than we are.
I mean, you've got the demographic that everybody wants. Young people at the start of their careers.
It's a young, very coveted demographic. Yeah. It's a great point. And they're already culturally relevant in connecting with that demographic, so that was ideal for us. But it's a very strategic partnership, and I think you're going to see us do more and more things like this, where campuses and the conference come together and provide great brands with solutions like we have here with PayPal.
And you're probably psyched. You'll get everybody. Who else would compete with you with other colleges?
Well, look, we are the best way to distribute the funds. And what's important is you need to have the wallet that the college students are using. They're not going to be adopting new tools and technology as they're sitting there. They're already using Venmo. They're already using PayPal. Their parents are already using it. The ecosystem exists. Now we get to work with our critical partners here and be able to make it work. So it was a natural partnership. It's a lot of work to make these come together, and I can't thank Brett and his team enough for being able to pull all these schools together and make this happen. But again, we're very, very excited about this, and it's a new day for college athletics and for PayPal as well.
I bet you can get some good seats.
Alex can sit wherever he wants.
I like that.
We're going to make that happen for
I like that.
I promise you.
That's amazing. The whole it's just mind-boggling how quickly things are changing. I can't believe that, that PayPal, which is now ubiquitous and has spawned so many great, founders and entrepreneurs, and now it's the Big 12. I mean, it's just culturally, it's just a major factor in all of our lives, isn't it? And athletes getting paid. No one would have ever thought
It is.
that.
And look, I joined 18 months ago.
Converged.
One of the biggest questions we had was, can you grow Venmo? And you're starting to see it now in the results. We grew revenue over 20% last quarter. We've got our Pay with Venmo up 50%, our debit card up 40%, and partnerships like this just enable us to reach our customers.
I've been with PayPal for a very long time.
Thank
I've
you.
got Venmo too. Now, every time I go to pay with PayPal, it asks me if I want to do the pay now, pay later option instead of just paying right.
Buy now, pay later.
Buy now, pay
Yeah.
later instead of just paying now for everything. How much of your business is that new kind of idea of get it now, pay for it later?
Yeah, look, and it's connected to the younger demographic. We are finding more and more college students and younger demographic wanting to pay with debit, and buy now, pay later is their credit option. And so our pay later, buy now, pay later product is growing very quickly. And it's becoming, we grew 20%, over 20% last quarter in buy now, pay later. And so it's becoming the way that people want to spend. They don't want credit cards as often. They want debit and buy now, pay later, and they can come to.
And we're back. And quote of the week, Charlie Munger: a lot of people with high IQs are terrible investors because they've got terrible temperaments. Cool is the name of the game. Patience, buy high quality businesses when they're temporarily marked down, and sit on your hands or go play golf. The secret to success is to do the common thing uncommonly well. Everyone invests. Very few people do it well because they're always chasing the shiny object. They're always sucked into the action, always chasing headline stocks, following the herd, and eventually leading to slaughter. Moving along. Let's get down to the data. Here we are. We've got, this is from Bank of America. Let's get this going here. There we go. Maybe I can do it this way. Yes. Okay, net debt to market cap and U.S. debt to GDP. This is pretty interesting. It shows that while the country's balance sheet is near historically bad, corporate balance sheets, S&P 500 net debt to market cap is at record good. Okay, so debt to market cap is around 10%, whereas debt to GDP is around 120%. I would not have guessed that for the S&P. That's pretty amazing. Here's from Fundstrat, non-commercial futures percentage open interest. So this is back to contrarian buy levels, what we saw near COVID lows, which is unbelievable. We talked about the sentiment today with Brad Smith. These are just still not numbers you see near top, so we're going to run higher. Total money market funds still 7%. When rates come down, all that money is going to be forced back into equities. They're right now just sitting out, collecting 4.5%, 5%. That game is going to be over. They're going to be forced back out on the risk curve. U.S. dollar bear market is a 20 to 40% bear market, just getting started. Dollar continues to weaken over time. We probably get short-term bounce. Bull bear indicator not yet at extreme. Gasoline price is below average for the past 4 years. That's not inflationary. Jay Powell. Weaker summer performance. That could be. We might have had a pull forward on the correction this year, so I wouldn't be too skittish yet. And I think even August, September, October is more going to be like sideways chop than another big crash. And then we're going to end the year higher. Raymond James. It's going to be more of a rotation. I mean, if you're just in indices, then yeah, maybe worry a little bit. But if you're in the right stocks, you're probably it'll be the opposite. When the indices are doing weak, those will start to do better. Moving along. This is from Kelly O'Grady, who I knew very well at when she was at Fox Business. She's now at CNBC News. She asked the best question of the entire conference with the Fed. So here's what she said, and this is some cojones, and I give her a lot of credit. You spent years talking about how you're data dependent. Be more direct. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut? And then she says, why wouldn't it be better to have rates that are more neutral as the economy heads into this period of very high uncertainty? You've said the inflation data is in a good place. We don't know how tariffs impact things. When you cut rates in December, there was still the what if of tariffs. So what made you feel comfortable cutting when inflation was higher and still the uncertainty of tariffs than where it is today, and you didn't cut today? I mean, talk about the question of the hour. Good for Kelly. That was awesome. More shelter disinflation likely in the pipeline. I think as rates go down, usually when you think of rates going down, prices go up. I think this is going to be the exact opposite this cycle. What's going to happen is a lot of homes are going to hit the market that have been trapped in 3% mortgages with millions of equity that are all going to hit the market at once and make homes more affordable. Share of Democrats and Republicans who expect stock to go up in the next 6 months. No Democrats, lots of Republicans. Median down payment falls for the first time in nearly 2 years. U.S. metros where you can buy a luxury home for less than $1 million is now down to 7, was at 35. Japan's core, thanks to Jay, Japan's core inflation hits highest level since January 2023, putting pressure on BOJ to raise rates, carry trade unwind. You'll see more pressure on Mag 7 in the fall. Lennar's gross margin on home sales for second quarter, again, lowest levels in 6 years. That's going to continue. The arms dealers will do well. They are going to continue to have margin compression. Oil prices must rise significantly to hit stocks durably. They're at low levels. I wouldn't hold your breath on that. International value stocks are outperforming this year by a wide margin. Iran's oil exports mostly go to China. It was interesting that Trump said that Iran can still export to China, wanting to get Iran to the table and wanting to get China's deal inked up. Real S&P 500 index versus conflicts. You can see these conflicts over the last 150 years and how the S&P trends up over time. Weak U.S. dollar environments create positive returns for financial markets and risky assets. What are the biggest beneficiaries when the dollar index falls 10%? Emerging markets equity. We've been talking about that for ages. Annual realized and bottom-up consensus EPS growth estimates. What's going to be the biggest? Again, this continues to be updated. Russell by far, 2025, 18% earnings growth relative to the S&P of 7. Next year, 37% earnings growth relative to the S&P of 14. Concentration of S&P market cap in earnings and the 10 largest index constituents. 10 largest constituents make up 38% of the market cap, but only 30% of the earnings, and that amount of earnings is declining. This shows a cyclical move for the dollar over the last 50 years. It runs in about 6 or 7 year cycles. You can see here we are at the top of the cycle and should be headed down for another 3 consecutive years for the U.S. dollar. Defensive sectors influence at 35-year low. Some of S&P 500 defensive sector weights, consumer staples, energy, healthcare, and utilities. Make of this what you will, but we argue that a thematic rotation is a better route to defensive allocations. I would say this is pointing back to 2000 levels, 2001, which we've covered a lot, which implies you want to start to get exposure to staples. We touched on it with Brad. Some of these defensive stocks, like the Hormels, like the Baxters, in healthcare, et cetera, like the Crown Castles, they are going to start to do well. And that probably begins right now in the third quarter after earnings. Once you make new highs in the market and volatility starts in August, these defensives are going to start to spike up. Returns are highest when multiples are lowest, but otherwise matter little. And that's where we are with our basket of stocks with low valuations and turning around massively. Rate cut expectations are now off the charts. I think it was 85% for September now and even 25% for July, which is new. Lowest positioning in net non-commercial futures, lowest positioning in 12 months to equities. So again, that's not what you see at tops. I think we're going to push higher and just force maximum pain from all the people who sold in the hole in April. Market implied U.S. recession probability indicator is average. Foreign treasuries holdings remain near record. Everyone said they were going to sell all our treasuries. It's actually at a record high. 2025 total returns, U.S. stocks 2.1%, international stocks 15.9%. That's probably a couple points now. I think U.S. is up 4% and international is like 15%. But we came into that with that minority view. Everyone said, oh, whatever, gave me a lot of shit for it. Well, it's worked. Charlie Bilello, U.S. office to residential conversions are about to explode from a trickle today to a flood in 2027. Empty office towers to apartments, condos, hotels. Future commercial real estate is going to look very different. I pounded the hell out of the table 2 years ago for those of you who are real estate investors to buy office in San Francisco, and those guys have made an absolute killing. Like insane money. I wish that was my game. Well, I don't wish that's what I wouldn't have made as much money doing that. But if by real estate terms, you would have made a massive, absolutely amount of money. So now I think if they're all converting to apartments, the way to play it is buy B and C office and sit on your hands, because eventually all the office is going to get sopped up, converted to a glut of apartments. Those guys are going to lose, and the ones that are left holding actual office are going to make a fortune. 1/3 of baby boomers say they'll never sell. Good luck with that. The word never is usually right before they do. Biggest inflow into energy. Once the supply hits the markets and price start getting bid and hit the air pocket, and they start to get fear of loss that all of their millions of equity that they worked their whole life for are evaporating, they're all going to hit the market at once. Biggest inflow to energy funds since October 23. Short interest has risen in 2025 year to date. So that's it. More fuel. Shorts are the first buyers as we push to new highs. They're all going to be forced in. All the people waiting for the retest we've talked about over the last week got absolutely monkey hammered. U.S. household assets and liabilities, total assets 179 trillion, total liabilities 19. Everyone's balance sheet is good. Corporations, people. The only balance sheet that's bad is the U.S. government. Equity ownership across wealth distribution, 43% in the top 100, 36% in the top 1%, 36% in the, so 10% own 79% of equities. Next 40% own 19%, and the bottom 50% own 1%. Economists raise China growth exports outlook for 2025. What is this? Oh, Case-Shiller. Oh, home prices month on month. Yeah, a lot of markets starting to get hit, particularly Florida and Texas. That's usually where it starts. Market concentration is a global phenomenon. Top constituents by market share. UK equities heavily weighted towards the top 10 stocks as well. Once a diverse index, S&P 500 is now around 50% growth. Weight of value growth plus FANG Mag 7 blend. Yeah, that's what you always see before reversals. It was the same thing in 1999. Dividend changes by percent. We'll skip that one. If higher in May and June, the rest of the year does very well. So when we've seen conditions like this, on average, 12 months out, up 14.8%. U.S. M2 money supply is now up 4.5% year on year, slightly below the historical average growth rate, but that's because we had such a big boom in 2000. But we've talked about global M2 money supply, which is now well at record highs. This is a critical chart here, showing emerging markets just now breaking out of this long cup and handle, which implies a measured move of at least 12 points, so 59 for starters. And then at that point, you're breaking out to new all-time highs, and you get a bigger cup, and you're looking more like move from 32 to 60, 28 plus 60. You're looking at a move to 88. We're at 47. So a basic double if you have a little patience with emerging markets over the next few years. Summer rally should continue. We agree. Major cities with declining home price growth, 35%. It's happening. We told you, and it's going to continue. It's going to be just the exact opposite. Once they cut rates, prices are actually going to come down. Just a supply dump all at once. Magnificent 7 or Magnificent Meh. You can see even now with all this huge rally year to date, you still have these majors that are down materially like Google, Amazon, Tesla, Apple. Magnificent 7 is still flat. Maybe this week it just went barely positive 1%, 2%. But that's it. Back to the top of the range. Probably another couple weeks of push through, suck everyone in, and then they'll be weak again in the fall. U.S. new single-family homes month supply. So supply is going up. All we need is rates coming down, and the game is on. Institutional clients net buying of tech, so they're all chasing up now. They'll get monkey hammered in the fall. U.S. stock valuations at a 75-year high relative to the rest of the world. You want to have international exposure, and you want to have it quickly. We haven't seen anything like that since when? Since 2000, 2001, which we've covered. What outperformed next? International, small caps, and value. What's not in this excess right here is value plays. That's when Buffett got rich in 2000 when they put him on the cover and said as Buffett lost his touch, he was buying Procter & Gamble. Everyone else was buying Amazon. Amazon was down 90% the next 2 years. All of his stocks were up. Active strategies gaining over during select major drawdown. U.S. accounts for a quarter of global GDP, but 2/3 of the MSCI World Index. That's a type of divergence that you can get rich on. Pause this, listen again, look at the table, and figure it out. Next chart, monetary aggregates, M1 leads 12 months, China and nominal GDP. You can see Chinese money supply has been going straight up in the last 6 months. GDP will follow. A big year for apartment buildings in big buildings. U.S. multifamily units completed by units per building. So offices are converting into apartments. Multifamily units, rear view mirror. Everyone looks in the rear view mirror. There's going to be a glut of apartments. That's not where you want to be. You want to be probably an office that no one wants, in my opinion. World gas demand rises to a record. God love you, Comstock Resources and Range Resources. There we go. Cumulative utility scale battery. So that's going to continue with the whole AI stuff. U.S. continuing claims going way up. Apparently Powell's not looking at this data. He's too busy predicting other data with his crystal ball. That's worked so well. Autopilot and transitory. Box office gross year to date through June 26th. It's actually cooking. And you know who's benefiting from that more than anyone else? Disney, baby. How do you like them apples? The media distributor gauge, Walt Disney Company is kicking ass, 11.4% in May, over YouTube, over NBC Universal, over Paramount, over Netflix. Nielsen's aggregated view of total usage by media company. Disney, baby, number one. How do you like them apples? 0 credit attributed to the stock. It's just getting started. China, building a mega-sized consumer economy. Premier says they're doing more consumer stimulus. We'll talk about that. 6 agencies announced financial support to boost and expand consumption in China. This was published this morning from Brendan Ahern over at KWeb ETF. Quote, 19 measures to, quote, combine the implementation of the strategy of expanding domestic demand with deepening the structural reform of the financial supply side, increase the investment in financial resources provided by consumption, and improve the level of financial services for consumer demand. Is China going through a consumption revival? Its 618 festival is one sign of it. The annual shopping festival's gross merchandise value surged by 15.2% from last year to an estimated 855.6 billion yuan, 119 billion US dollars, according to retail data provider Sinton. Shoppers spent on consumer electronics as well as beauty and pet care products, with certain consumer products receiving a boost in sales from Beijing's trade-in subsidy program. Stimulus, ladies and gentlemen, while the festival started with a bang. Okay, 618 shopping festival with sustained brand growth, Taobao and Tmall. Citibank after that. Alibaba stock could surge another 50% after blockbuster 618 festival. Investors are most positive on emerging market in 2 years, HSBC survey says. Opinion follows trend. China tech firms ramp up M&A deals with the blessing of Beijing. The game is back on, ladies and gentlemen. European car sales rise as demand for plug-in hybrids soars. Where does Cooper Standard make the most money? Off of hybrids. Hybrid cars, once derided and dismissed, have become popular. More parts per car for Cooper Standard. U.S. new vehicle sales set to rise 2.5% in June. Report says, highlights from report, North American light vehicle production outlook has increased by 434,000 units for 2025. Do the math, ladies and gentlemen. That's if Cooper does about half of that, that's 200,000 units by $150 a car. That goes straight to the bottom line effectively. 2025 forecast was also raised by 248,000 units for light vehicle sales. That's from S&P. Second Fed official indicates support for faster rate cuts. This was Bowman, Waller, Goolsbee. They're all going against Powell. Federal Reserve releases plan to relax key bank capital rule. I covered this with Brad Smith, and I've been telling you guys it was coming for the last few months. The supplemental leverage ratio, they're going to reduce capital requirements to bank. Huge demand for treasuries, going to bring down 10-year yield 30 to 70 bips. 30-year fixed mortgage will be below 6 before the end of the year. Real estate boom will be on. Stanley Black & Decker, Generac, QXO, all going to be beneficiary. U.S. Treasuries face stable coin-driven demand surge as supply looms. Fiserv to offer own stablecoin partners with PayPal and Circle. White House says decision on nominating next Fed chair not imminent. We covered that with Brad. You can take our view on that. Intense heat to push biggest U.S. grids power use to 12-year high. Natural gas, Comstock, new renewables get reality check as gas demand returns to growth. Insatiable search for compute power could drive another commodity boom. Same as 2001 to 2007. Summer gas prices haven't been this low since 2021. Existing home price sales rose in May. Economists expected a drop. China going through consumption. There we go. QXO won't raise its offer for GMS after report of Home Depot bid. GXO, two huge announcements. Announces the completion of the regulatory review of Wincanton acquisition and raises full year 2025 guidance. So they got that approved. So now they can start to integrate. That's going to be huge for GXO. They also got an incredible new CEO from DHL, which is the #1 logistics company in the world, right ahead of GXO. So they got their best person off to the races. Goldman and Citi see Europe's economy powering stock higher rally. And time for a makeover, Estee Lauder update. So each week we try to cover 1 to 2 companies we've discussed in previous podcast VideoCasts. As you can see here, cash flow is starting to recover, but it's still iffy. Margins are starting to recover. That's actually real. A lot of good things beginning to happen. Key thing here, which Jeff wasn't able to circle, is you can see that over the past decade, the return on invested capital has been in the high teens to low 20s consistently until 2023. And this is coincident with the drop-off in sales in China from 2021 to 2024. Those are starting to recover. I think we're going to see a quicker recovery because it's not baked into the outlook, the China recovery. The beauty is during the drawdown is that they did not lose much share in China. They kept about 99% of the share that they had. They have #1 share globally for premium skincare and cosmetics. That's not going to change. And for those of you who don't know, they cover a lot of brands. It's not just Estee Lauder, it's MAC, it's Clinique, it's Dr. Jart for the young kids, love the Korean stuff. It's Aveda, it's more than you know. And they've been buying and selling brands for 75 plus years, and they'll continue to do that, similar to VF Corp, similar to Diageo. Last month, we put out a quick update following Estee Lauder's Q3 earnings, but had not yet published a full deep dive. After falling below $50 a share at the April lows, the stock has been on a tear, rallying more than 50% off the bottom. Just this week, Deutsche Bank turned bullish on the turnaround story and issued a street high price of $95. We thought now would be a good time to revisit the name. Estee Lauder, founded in 1946, is the global leader in premium beauty products with a portfolio of over 20 best-in-class iconic brands. Estee Lauder is basically to makeup and beauty what Diageo is to alcohol. Both are about as premium as it gets. The stock was never a huge position for us like Alibaba. It is largely a bet on the recovery of the Chinese middle class, and just like poker, we prefer positions with plenty of outs, and few offer more outs than Baba. So while Estee Lauder may not be the everything business that Alibaba is, it still offers what we believe is a highly attractive risk-reward setup. Estee Lauder's roller coaster story over the past few years goes like this. When their prior CEO, Fabrizio Freda, took the helm in 2009, his top priority was international expansion, aiming to generate over 60% of overall sales from international markets. That bet proved highly successful over the next decade, but also opened the door to significant overexposure to certain markets, especially China and travel retail. From fiscal year 2018 to 2021, China's share of total revenue jumped from just 13% to 36%. At one point, a single customer in China was responsible for 42% of the region's sales. Management clearly bit off more than they could chew, and when the music stopped in 2022, Estee Lauder paid the price. Shares fell from nearly $375 to below $50 this past April, effectively wiping out more than a decade of gains. Now this is exactly the kind of situation that earned me the nickname Turnaround Tom. As Buffett says, great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. That is the guiding light of our entire company at Great Hill Capital. That is the theme of everything we do, is great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. We benefit from that misappraisal. This could not be a more accurate description of Estee Lauder. At the end of the day, this is a company that is as high quality and durable as they come, working its way out of a once-in-a-100-year event, yet priced as if it is in permanent decline and people will never spend money on makeup again. Oh, and by the way, it's kind of the reverse GLP. As people lose weight, they buy more makeup, not less. We are more than happy to take the other side of that trade, and that's because we see the bulk of Estee Lauder's challenges as cyclical, not structural, with all signs pointing to a bottoming and near-term recovery. The name of the game with Estee Lauder turnaround is margin expansion. Gross margins fell nearly 500 basis points peak to trough, bottoming in fiscal year 2024 at 71.7% as management worked through excess inventories and write-offs. The good news is the gross margins have now posted 3 consecutive quarters of 300 basis point gains, with current guidance calling for 73.5% for fiscal year 2025 and an expected return to the historical mid-70s range by fiscal year 2027. Operating margins are where the crux of the turnaround really is. Estee Lauder has historically delivered mid to high teen EBIT margins, but in 2024, these bottomed out at just over 10%. Management is working to restore EBIT margins to a solid double-digit level over the next few years. And with the profit recovery growth plan expected to generate $800 million to $1 billion in annual gross savings, and the full run rate benefits anticipated by fiscal year 2027. Green shoots across the businesses continue to point toward a return to growth in 2026, which will allow operating leverage to really kick in and get Estee Lauder back to making more money than they know what to do with. At the same time, you have a new CEO who is a proven winner in the industry, a push into higher margin digital channels like Amazon and TikTok, and China working its way towards becoming a mega-sized consumption economy. We think over the next few years this is a double from current levels. Until then, we are happy to sit on our hands and wait. Now here's an in-depth breakdown of Estee Lauder's Q3 earnings. As the CEO said, quote, return to sales growth in fiscal 2026. You should go through this line by line. We've outlined the gross margin expansion, expanded 310 basis points to 75% in the quarter. achieved prestige beauty share gains for fiscal 2025. By the way, 10 years ago, prestige was 33% of all category purchases. Now it's 40%. This is a huge play on the emerging market, middle class expansion. They'll be one of the pure beneficiaries. On-trend commercial notifications, 10 new freestanding stores, TikTok shop. Okay, all this stuff you can look at. Let's just scroll down for now to the 10 key points. You can see the improvement in China. All right, 10 key points. Number one, after sales declined 10% in fiscal year 2023 and 2% in 2024, and with guidance calling for another 8 to 9% in fiscal 2025, management remains confident in a return to growth by fiscal year 2026. Gross margins bottomed in fiscal year 2024 at 71.7, below the 5-year average of approximately 74, but have rebounded for 3 consecutive quarters with gains of over 300 basis points. Fiscal year 2025 guidance calls for 73.5%, and management continues to target a return to the historical mid-70s by fiscal year 2027. 3, management also remains confident in restoring operating margins to solid double digits over the next few years as a return to sales growth allows operating leverage to kick in. Margins bottomed in fiscal year 2024 at just over 10%, well below the company's historical mid to high teens EBIT levels. Green shoots are emerging across the businesses, with market share gains showing up in the U.S., China, and Japan. In the U.S., Q3 marked the first quarter in years with share gains driven by growth in 3 of 4 categories: skincare, makeup, and hair, and 10 brands that held or gained share, led by Clinique, which has now posted 11 consecutive quarters of gains. In China, Estee Lauder gained share across all 4 brand categories and 8 brands, making it the 3rd quarter of share gains in the last 4. And Japan, Q3 marked the 4th straight quarter of market share growth. Tariffs are not expected to have a material impact on fiscal year 2025 profitability. Estee Lauder has the lowest exposure in the industry. Thanks to its 9 manufacturing sites worldwide, over 75% of what is sold in the U.S. is sourced from the U.S. or Canada and is protected on the USMCA agreement. 25% of what is sold in China is currently sourced from the U.S., but management aims to reduce this to less than 10% and has already mitigated north of 40% of the initial tariff impacts. Travel retail, which is at its peak, accounted for mid to high 20% of total sales, thanks to shrink in the low teens as a share of sales. Management is intentionally diversifying away from volatile travel retail, significantly reducing inventories and de-risking the segment. Outside of travel retail, which declined 28% in Q3 and is expected to see another steep drop in Q4, Estee Lauder delivered sequential acceleration in global retail sales growth. 7, management remains on track with the Expanded Profit Recovery Growth Plan, PRGP, which is expected to generate $800 million to $1 billion in annual gross savings, with full run rate benefits anticipated by 2027. As of Q3, management has approved initiatives to eliminate over 2,600 net positions, with 85% expected to be completed by the end of 2025, and has already reduced middle management roles by 20% year over year. 8, Estee Lauder continues to lean into higher growth, higher margin digital channels, with online organic sales up mid-single digits in Q3. This includes 12 brands now available through Amazon Premium Beauty Stores, as well as momentum on TikTok Shop, helping digital channels reach 28% of total sales in 2024. That's up from just 13% in 2018. At the same time, exposure to department stores has been significantly reduced as a share of overall sales. 9, capital expenditures totaled $395 million, 3.62% of sales in the 9 months ended Q3, down 44% from $702 million in the prior year period. Construction of the new factory in Japan had pushed CapEx as a percentage of sales to around 6% in recent years, above the historical average of 4 to 5%. But spending is now expected to remain lower as management shifts focus to higher return on invested capital projects and allocates CapEx towards consumer-facing initiatives rather than capacity and capabilities. 10, in the first few weeks of Q4, management has continued to see strong retail momentum in the U.S., even stronger trends in China, and positive momentum in U.K. across other emerging markets. Here's the earnings call transcript. You can go through the green highlights we put here at hedgefundtips.com. Just scroll down to popular posts. It'll probably be the number 1 or 2 most popular posts for the next 24 hours. You can see the questions from analysts, the responses. This gives you the nuance and the granularity you need to have an edge if you're going to do this seriously. Moving along. There's a lot there. I don't have my normal mouse this week, so bear with me. It's a little better. Here's an article from Morningstar. Estee Lauder is poised to ride the beauty premiumization tailwinds. Very similar story to Diageo, leader in products. Scale cost advantage, blah, blah, blah. 20 years, middle-class consumers, global upgrade from mass brands, shorter lead time, digital platforms. Bottom line is they talk about ample liquidity, and they talk about a price target of $125 fair value, currently trading at 75 up from 50. So we like that story or that take. Fear and greed still not yet at euphoric levels. National Association of Active Investment Managers getting up there. Congratulations to all the new clients that came in during our Q1 and Q2 2025 raises. You cannot be better positioned for what we believe will continue to be a highly rewarding remainder of 2025. If you thought the first half was unbelievable, wait till the second half in our view. This view is based on what has already taken place in 2025, as well as much of the data we've shared in recent weeks on the podcast VideoCast, coupled with our proprietary methods of expressing and executing upon those views on your behalf. We will reopen to smaller accounts, $1 million plus, again starting on July 1st. Congratulations to all of you I had the pleasure of speaking with and onboarding in the last week when we opened up the queue for inquiries. That is still open. Several of you have already had your applications approved by Interactive Brokers, so we can start deploying capital on your behalf imminently. To see if you qualify and to take advantage of this opening, click here. Just go to hedgefundtips.com, click on Money Management. Larger accounts, the 5 to 10 million plus, can access bespoke service at their preference here. Not a solicitation, opinion, not advice. See terms. Talk to your financial advisor before you ever do anything. This is for informational purposes only. Technology estimates, earnings estimates and revisions, top 30 weights, last 60 days, up 1.31% this year, up 64 basis points for next year. Consumer services, communication services, same story, up 1.59 for this year, up 1.75 for next. So we're past that period of year where they take down guidance. Now they're starting to take it back up. Economic data, again, same stuff we've covered about employment, about housing, etc. And now on to the Ask Me Anything questions. We have quite a few this week. If you like the Ask Me Anything, stick around. If not, we'll see you next week. Same time back in California, though. And here's question number 1 from Mike S. Thoughts on Clorox? Mike, we covered that a couple weeks ago. It's fine. Not the highest and best use for us, but a decent company at a good price. Not thrilled about the CEO. Maybe they'll change her out. Theo Dumont, many thanks for all the lessons. Best of you and your family. Why did Etsy do a convert? They wanted to be as non-dilutive as they could and not pay high interest, so I kind of like that play. That's a new client inquiry. Tom Jones. Love the podcast. Keep up the great work. What are your thoughts on Shoe? Steve Madden. Let's take a look. SHOO. I haven't heard anyone talk about Steve Madden forever. I mean, you just want to understand how they're going to turn around free cash flow here. I mean, I'll take a quick look at the balance sheet. It looks okay. I don't like it. It's not the type of business that I'd be involved in, but I think you're going to be fine with it, and I think it's pretty good analysis and worth understanding their competitive moat. Let's just take a look at their balance sheet before we do anything else. If that's okay, it's probably worth looking into further. Yeah, I would take a good look at it. It looks generally okay, so good work on that one. Drew, usually ask a question about a company. This week I wanted a chance to say thank you. That's kind of you. This is from Drew Robinson. I've been listening to your podcast start to finish every week since senior year of college. Beginning my young investment careers during ZERP when everyone, including myself, was chasing shiny objects. I can't imagine where I'd be right now if I had not found this podcast. Thank you for sharing your hard work with your loyal listeners every week. I share the pod with everyone I know and will continue to do it. Well, thank you for that. That is the number one way you can say thank you. If you can't afford to be a client, share it with one or two people you care about that love the markets. He said, P.S. Let's just say the golf course this weekend isn't ready for me in my new Hedge Fund Tips golf hat. Picture coming soon. All right, I love it. We'll get you up on the website. By the way, we've got some new pictures up on the website of people that were kind enough. We've had like pictures to orders. I would say, very, very small amount of pictures, but they're starting to trickle in, I guess, as the products come in and people feel confident doing it. Even if you want to go anonymous, you can just, put first name and last initial or whatever. Let's see. Those have been around. There's some guys we covered last week. Oh, here's a new one. Stephen Jadish down at the Wildwood, New Jersey shore. Patrick, I think we covered. So we got a lot of new ones coming in. Excited for that. Those of you who want the swag, just go to Hedge Fund Tips, click on the merch store. That's cool. All right, moving along. Thanks for that kind email, by the way. We'll look forward to get your picture up on the site. Simon Stazinas, Amerigo Resources, was suggested by Big Short guys as long yesterday. Well, I worked for Cornwell, so I don't know that they're in that. I think miners, as a general rule of thumb, other than Albemarle, are crap. Businesses, even when the price of whatever they're mining goes up, they find a way to lose money. It's just a terrible business. ARG.to. All right, cash flows are recovering, revenues are recovering, margins are recovering. So they're in the secular move here, but I think they're towards the top of the range. What do they mine? These guys that are always bearish all the time, and then the market makes new highs and they're forced to buy something, they always buy these pieces of shit that wind up doing nothing for them. So what do these guys do? Copper and copper concentrates in Chile. I mean, this is like too hard pile, gamble and win maybe, gamble and lose likely, hard pass for me. Okay. John Wicker, love the pod. Thoughts on General Mills? I think this is in the group that's going to start to get bid in the fall, along with the Hormels and I just don't think this has come down enough for me to get interested yet. At 40, I'd probably be a buyer. Yeah, you just want to see some recovery in margins and revenues before you go crazy. Unless it gets down to 40, then you can kind of pull a Jay Powell and predict the recovery. But I like it below 45. I don't like it here, and I may never get it. So we'll just wait on that or do nothing. More likely do nothing. Jimmy Jones. Yeah, Hormel is just a defensive spot in our portfolio with a margin of safety. He's talking about the interim CEO. Yeah, I wish they had their final CEO, but he'll fix things up. The business will start to turn. They'll get a hot shot in there. So it might take a little longer, but in the meantime, you got a nice dividend, and it's fine. I mean, could I see myself selling out of Hormel and buying Kraft Heinz? Possibly. They're both kind of the same characteristic, but they're both going to basically do the same thing when that group turns. And same as General Mills, those just have a bigger upside than General Mills or Campbell's for that matter. Campbell's kind of a dog. All right, Jason Zen, Global Payments. We've covered this one, Jason, a million times. We just don't like the business. So I'll leave it at that. I think you're going to be okay on this, but I just forget what was the thing from the work I did a while back. I think it had to do with the opacity of the portfolio of the assets that they held, or the margin compression. But there was something I didn't like about it. I think it works as a trade here. I understand why you're interested in here. Free cash flow's going fine. Margins are going fine. Starting to recover. I've just never liked this business from a quality standpoint. I'd rather be in PayPal, but I think it's going to work for you, so good work on that. Chuck. Okay. Here's Daniel Estevez sent Teleperformance, TEP. It's a French company. Free cash flow is going through the roof. Revenue's going through the roof. Margins are starting to recover. Return on capital has been spotty. Business has been around for a long time, if I'm not mistaken. Founded in 1910. Digital business services company, operates specialized services segments, customer acquisition services, business process management, blah, blah, blah. They do a million things. Seems like a company that's been pretty nimble over the years in adjusting to environments. Balance sheet, let's take a look. $1 million of cash. Good. Statement. Had some big growth. They must have done an acquisition. Good. Balance sheet generally looks okay. I mean, it's generating a return on capital that's probably, I don't know if we have weighted average cost of capital here. No, probably below its cost of capital. Yeah, look, I think this one is definitely warrants doing some work. I mean, it's just going to be really understanding what is the competitive mode on all the businesses that they're doing. Why is the stock down so much? And what's the turnaround story? But it's cheap. It looks like it's starting to grow again. Balance sheet seems okay. Check when they have to refinance everything, and I think you're on to something, Daniel. Moving along. David Berger, Marriott Vacation. Yeah, I don't like that business, but they run in cycles, and when they make money, they mint it. Yeah. I don't love this business anyway. I would just say, yeah, I think you're right, but I'm not going to participate in this. I just don't like the business. It's too cyclical for my taste. It's just not a clear, in other words, I'm not getting enough upside relative to the risk, but I do think you're going to be right. I would just watch. The balance sheet doesn't look great. $5 billion of debt, $200 million of cash, not ideal. That's what I'd be worried about. It's never generated a good return on invested capital, so this is more of a trading vehicle than a own forever vehicle. I don't love it, Dave, but I think it's going to work for you. Just be careful on the balance sheet side. That's a client inquiry. Brendan Garvey, Halliburton. I think I said Halliburton was fine a few weeks ago. If you have to be in it, I'd probably choose that or Schlumberger. I don't like it enough, but I think it'll work here, and we covered that in more detail back then. Another client inquiry, Patrick Kelly. Thank you for the continued hard work that you put in the weekly podcast. It's always fun to come home Thursday nights knowing that I don't have to flip through 5 streaming services looking for something to watch. I would be grateful if you could take a look at Robert Half. Company's got really beat up. Long history of navigating challenging environments. Retired 23% of stocks. Clean balance sheet. Okay, Robert Half. I think this is a staffing business. RHI. All right, so their revenues and cash flow are not turning yet. What does their balance sheet look like? So in these, you just got to go do the work and find out what's the plan to turn it around, and then you wait to see some signs of the plan working. But yeah, this is a kind of a durable business. It probably bounces back, $70, $75 range. It's $40. It's not a great use of capital for us. And you definitely need to start to see some recovery and understanding of the turnaround plan. But let's just see if you got waiting time to do it. Yeah, very, very de minimis debt. So I think you're probably okay here. I don't love it, and you should probably listen into 4 to 8 of the last calls, find out what they're doing to turn the thing around. Rob Sarnataro. Great show, informative yet very entertaining. My question is, what factors do you consider if a stock hits your expected target price while still in the short-term tax window, sell and face the tax consequences, or hold and risk downturn? Usually we're not getting into a stock unless it's a double or triple plus, and those usually take more than 12 months. But on occasion, you've seen it here, whether it was Vornado or others, Rolls-Royce, where they go double or triple quicker than we anticipated. It's inside the 12-month window, and if it exceeds our target, we take the profits and eat the ordinary capital gains because we buy things with a margin of safety and we sell them when they're at excess price, and we just stick to our discipline. But the good news is our average holding period is 3 years, so that's rarely a factor. Some happen faster, some take a little longer, but on average around 3 years. Hey Tom, what are your thoughts on Kraft Heinz? Yeah, we like it. We covered that last week or the week before. Lee Foster, BME in the UK. Did you do any more work? No, I said it was worth you doing more work. I'm not interested in it, but I thought it was worth you starting to do research if you like it. In other words, it passed the sniff test. Let me just double check this one. Yeah, I think I specifically said I don't like it because it's a supermarket, and that's a terrible business, but let me just double check. Yeah, I would never get into the grocery store business. I do think this one's going to be okay. Let me just double check the balance sheet. And I think it's going to probably work for you, but I like that in airlines, you'd really have to put a gun to my head and be like the last of 5 things I'm allowed to buy for me to consider, no matter how good the numbers are. Like, you could send me 1 million Chinese stocks. If they're not named Alibaba or Tencent, like, I'm just not buying them. Because the odds are against you in certain industries and certain countries. So you really have to have such a spectacular deal that you can make money if everything goes wrong, because in those areas it often does. So here, I think the issue that you're going to have to deal with, balance sheet's a little leveraged, but it's not crazy. Yeah, let's see the margins. Margins are improving. Again, I think you're okay if you understand the business. If you live in the UK and do that work, I think you're probably worth exploring it. That just tends to be a garbage business. It reminds me of Tesco that Buffett got bagged in. Hi, Tom, longtime listener. Thanks for all you do while I'm kind of undervalued relative to large cap. You think increasing influence, abundance of private equity has structurally reshaped the poll in a negative way? Best thing to take in private. No, that's a load of shit. Small caps are going to fly. Stop overthinking it. On to next. Marco Staltari. First question ever. About gold and the euro. HII. Military shipbuilder. Nuclear carriers. HII. All right, let's take a look at that, Marco. I think you might be speaking my love language, my man. I think it's late, though. This thing's already up 60% off its lows. As a general view, no, I don't like it. It's just turned negative free cash flow. Stock's up, anticipating a turnaround that hasn't happened yet. This is the kind of stock I'd love to see go back down to 160 or 150 and then just buy every share once I see a little turn in free cash flow. But there's no upside here. The fundamentals have gotten worse and the price has gone up. Not interested yet. But I generally like the business, Marco. And congratulations on your first question. Thank you for your support, Liam Cook. Thanks for all you do for the podcast. Listener for 6 months. Wish I'd have started listening earlier. Currently holding 1 small cap Cooper Standard. Would you want more exposure in a portfolio of 12 stocks? Yeah, we have more. I mean, Cooper Standard is a small cap. We have a little Canadian Goose. We have Comstock has been a big run mover for us. 3 or 4x already. That was a small cap. I don't know if it still is. I guess it still is. That's more than enough small cap exposure. VF Corp is like a small to mid. Okay. Brandon, that's a new client. Want to become a new client. Bharat, new client. Anton. Okay, looking at buying gun dealers in healthcare, not the soldiers. Might want to look at GXI. Hard pass. Huge negative free cash flow. Margins declining. What does this thing do? Critical packaging and delivery systems. Yeah, not yet. I want to see more of a turn before I get interested in that. Anton from Denmark, but thanks for the question. Adrian Smith. So I started half position in QXO the end of April with the intention of adding to it over the coming months. Since then, it's up around 85% in less than 2 months. Obviously not going to complain about that, but was only able to get a half position. What do you do when a position gets away from you before you can make a meaningful position? Nothing. And number one, and usually I put the whole position on it at once, or at least, 80, 90%. If it goes lower, I add more. If it goes higher, I have what I have, and that's it. I don't chase up. Thank you for your great content you put out. Been invaluable for growth as an investor. Well, you're welcome, and good question. CK Patel, love your podcast. Would like to find out your thoughts on B2B I think we covered this one. I don't like this business. Bath and Body Works. It's probably fine. Let me take a look at the fundamentals here. Cash flow has never recovered to peak. Revenues, margins are kind of, what's the motivation here? You want to ride from 25 to 50? I wouldn't chase that. I don't think there's any, I don't think that's a great business. I don't think it has a great moat. I think it's like a fad that runs in cycles and eventually goes out of business. John Francis, Porsche, you Porsche people, all right. No, I won't buy any OEMs no matter how cheap they are. Even Ferrari, which has done well. Okay. And that's it. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Oh.